Hello, everybody. Welcome back to another market close. It is Tuesday, April 30th, 3:45 p.m. And I put on the suit. I said, you know what? We haven't put on the suit in a while. We haven't gotten dressed up in a while for an earnings. Today's a big one. So this is one I got from Shein. A bunch of Chinese kids were building this probably for 50 cents an hour, and I got to pay $7 for it. But nonetheless, this is also the type of shit you buy from Amazon, which is why they're probably going to have, hopefully, a good earnings. So I was like, you know what? We might as well match the vibes. Amazon is today. SMCI is today. AMD is today. Starbucks is today. Today is going to be a monumental week in the world of the stock market. And we've got a lot of earnings to be able to talk about and discuss. So thank you all for joining me today. I really, really appreciate it. It means the absolute world that you guys are here, and then we get to discuss and see what happens together in the stock market. I'm looking at PayPal right now. Obviously, it's been a red day, and it's been an aggressively red day throughout the entire market. We'll talk about PayPal in a second. This is the earnings watch list for 4/30. So these are the 4 stocks we're looking at. I think there's a couple of other stocks, but these are the main ones that I think matter. Let me just check April 30th today. Last day of April, dude. We're in May tomorrow. Can you believe that? We're in May tomorrow. After hours. Yeah, nothing else. Nothing else. I mean, Lemonade. I'll add Lemonade. Oh, Pinterest and Lemonade. How did I forget those? Yeah. Pinterest, that's a big one. And then Lemonade. Not the biggest companies, but definitely important stocks to look at in terms of the health of the consumer. One is insurance, one is advertising, so that's important. Then we got SMCI down 2% of the day. Starbucks up a little bit. AMD down but basically flat, 0.08% of the day, and Amazon down 1% on the day. So this is going to be a big day for all of those companies, and we're going to have to discuss kind of what ends up happening here. Before we get into that, let's do a little bit of macro. PayPal is one of the only stocks that's green today, and I think this is very, very bullish for PayPal. It is a red day. Tesla is down 5%. CleanSpark down 8%. The S&P 500 down 1%. It's down 5 points. When you're down 1% on the indices, I mean, that's not easy to do down on an index. SoFi, I mean, we'll talk about them later, but they're down 4%. I did buy a couple more SoFi options today. MicroStrategy down 16%. MicroStrategy is $80 away from going below 1,000. Bitcoin, the reason why it's down is tanking. If we go to Bitcoin real quick, as you can see, wow, right below 60. It was fighting to stay above 60. We bottomed at 59,688. Right now at 59,943. I can give you the reason we're down on Bitcoin. It's not that complicated. ETF inflows have dried up dramatically. Like, it's bad, guys. Like, the people are not like BlackRock has had 3 days, 72 hours of no inflows. It is not good for Bitcoin right now. And I don't know what's going to trigger those inflows to start reaccelerating. Hong Kong just approved ETFs, I think like last night at 12 a.m. or something. So like, yeah, there's some movement there, but until then, Robinhood's down 5%. Coinbase is down 6%. A lot of these companies are going to get hit because they are ultimately pegged to Bitcoin. In terms of the Mag 7, as we can see right here, the only one that's green is Meta, and that's probably because Meta already got beaten up over the past couple of weeks. Apple's down, Microsoft's down, Google's down, Google giving back some of its gains that it got last week. Amazon down, Nvidia down today, just slightly, and then Tesla down 5%. Tesla being down is not that big of a deal. It's up like 25% in the past couple of weeks, so it makes sense that Tesla would give back some of their gains. Elon has unfollowed some very big Tesla accounts in the community, and I thought it was surprising that he did that, and I think partly the reason is they both tweeted some, I guess, confidential information that Elon sent out as an email to his to the Tesla employees, and it was around layoffs. And I guess that was like, not supposed to be leaked, and somehow they got the information, they put it out there, and so Elon unfollowed them. Elon potentially going back into demon mode. If you read Walter Isaacson's biography of him, he's kind of like getting rid of all the shit and just like going all in, and maybe that's why he's unfollowing some of the biggest Tesla accounts, which obviously I think you would enjoy some of that Tesla content if you're the CEO of Tesla, but he doesn't want to see that shit because it seems like he wants to focus. So the reason why everything is red and I'm still bullish on PayPal is because PayPal somehow maintaining a 2% pump. PayPal should be $73 right now. 1.5 billion in buybacks, 9% revenue growth. They guided for 6.6% revenue growth. They raised full year guidance. They beat on EPS. They didn't beat on a non-GAAP basis, but on a GAAP basis, they're fine. So that was good for them. Free cash flow is going to be about $5 billion. And transaction margins went up. Total payment volumes also went up by about $7 billion. The street wanted 394. They brought in 404. So in general, I think PayPal being green is a testament to how bloody red the market is, but PayPal still being green, which means once we get a good green, relative surge in the market, which there is a catalyst for that I'll talk about in a second, maybe PayPal inches much higher to where it needs to be. Now, what is that surge that we're looking for? And this is going to deeply impact Amazon earnings as well. Papa Powell. Tomorrow is the FOMC meeting. Powell's going to have to make a decision on if we hike or if we pause or if we cut. Let me know in the chat what you think is going to happen. I think we're likely going to pause. We're not going to cut. We're not going to hike. It would be funny, though, if Powell went on live TV and he was like, well, you know, I think it's time for us to climb a mountain. And in order for us to climb the mountain, we all have to go on a hike. And then he just like, you know, dropped a hammer and was like, yeah, we're doing a hike, guys. Like, could you imagine? I wonder how the stock market would react to that if he announced a hike in a funny way, you know, like in a comedic way. Now, he's not the type of guy to do that. If I was the Fed president, I would do that. So you don't want me to be the Fed president because I would make light of the situation by literally, you know, making it funny that we're getting a hike. They would be asking me questions like, guys, inflation's, you know, it's at the top of the mountain. We got to go to the mountain. We have to hike to get to the mountain. That's why we're doing a hike. Like, that's how I would do it. But granted, I think that a lot of people are becoming ultra bearish on what Powell's going to do. There's these talks that we're going to get rate hikes and never going to get any rate cuts until 2025. I think a lot of that is bullshit. Oil is coming down. We see oil coming down every day. Shelter is lagging. We know shelter is lagging. Look at this. Oil's down 1%. The Iran-Israel stuff is getting a lot better. Middle East geopolitical tensions are not that bad. Look at WTI crude. It's down. It's $1.70 away from being below $80. Shelter's coming down. The Japanese yen stuff is not that good, but I think we have some time before that really, you know, hits the fan, and maybe that does in the next year or so, but I think we're okay. And so in general, PCE came in at 2.7. It's likely going to be lower at 2.5, I would say, by September. CPI is not going to be at 3.5. If I'm wrong on this, then yeah, the whole market's screwed. But I think Powell knows it's going to be okay. So I think Powell's going to come out there tomorrow. He's going to say, hey, we're looking at the data. A lot of his little minions like Neil Kashkari and Bostic I actually respect a lot, but the Fed presidents are going on TV saying, well, we have to be a little skeptical about inflation. They're doing that to calm markets down because they're afraid markets are getting euphoric, which for good reason. The S&P was at 525. 3 weeks ago. So like, I think the pullback even we're seeing today is very reasonable. NVIDIA still is up 65% year to date. So it's not that big of a deal. But at the end of the day, I don't think we need a hike to justify some of the activity that's going on in the economy. And so I think tomorrow's going to be okay. And then it's a question of, does the market respond to a pseudo dovish Powell or a hawkish Powell that's not as aggressively hawkish as he was in the Canadian Prime Minister panel that he did a couple of weeks ago. And so we'll see. We'll see how it plays out. Clive says with a bad GDP, if Powell increases interest rates, he'll kill more than the market. That's another good point. GDP estimates came out to 1.6%. The market was expecting 2.5, and and the previous estimates were around 3.4. So bad GDP, low unemployment, inflation not going higher, potentially in a stagflationary environment. Then Powell says, yeah, we're going to raise rates. Get out of here, dude. We're not doing that. There's no way. If he does that, it's just, I don't think it's happening. So I think Powell will be early to rate cuts because he was late to rate hikes with the inflation story being transitory. And so we'll see. We'll see how that plays out, but I think it'll be okay. Thomas says that wasn't RPM. Okay, it was some Canadian dude. It wasn't did I say Prime Minister? Yeah, that wasn't Justin Trudeau. My bad. That was some dude in Canada who was part of the communist dictatorial regime of Canada. I'm just kidding. It was some Canadian guy. But Powell was in a meeting with him. Ironically, the Canadian guy started talking. The market was going up. As soon as they gave Powell the mic, market started going down. It's because Canadians are nice, right? And so markets are, they respond nicely to Canadians, and then Powell is aggressive and mean. So that's what we got going on. Garcia, what's up? Matt, what's up? June, what's up? Thank you all for being here. Kay Katana says you got a date later, Amit. LOL, nice blazer. I have a date with Amazon, hopefully going higher. Let's get into the Amazon preview. So what am I expecting on Amazon? 178.2 right now, down 2%. It was just down 0.9%. So it's going down a little bit aggressively before we get to the market close. I think Amazon needs to do one thing and one thing only. Jassy needs to lay out the vision that he laid out in the Q4 earnings call. In my opinion, from all the earnings calls I listened to, wow, Amazon's actually going, you see that red candle? It's actually forming a little bit of a thicker red candle. In Q4, the only CEO that actually laid out a real AI vision was not Sundar, was not Satya, was not Zucks. It was Jassy. And it's not because those guys had a bad AI vision. It's because Jassy knew exactly how LLMs and artificial intelligence infrastructure would implicate customer interactions with their products and also enterprise interactions with their products when it comes to AWS cloud and AI cloud. So I think if cloud continues to compound at around 23%, and the margins on e-commerce get a little bit better because we're starting to see those bottom and those inch up to maybe 5-6%. I think right now they're at 3 or 4. I could be wrong on those numbers, but if those go up a little bit, I think Amazon's going to be fine. I think their PE is going to come down. The growth is going to go higher. Now let's put in the chat. Let me, Amazon's crashing right now. Yeah, it is crashing a little bit. Let me do the final poll in the chat. What do you guys think is going to happen to Amazon? Here's my question for everybody. Do you think there will be a dividend? Do you think there will be a dividend? So Amazon, either moon or dump. Let's put it in the chat. We're also going to do this. We did this last time for Tesla. Whoever puts, so in the chat, put moon or dump and then put a price target. Whoever gets the exact price target or close to the price target, you will get a $25 Amazon gift card. Shout out to who won it last time? Ryan Carlson. He got the gift card from me on Twitter. So put dump or moon and then put your price target, and whoever gets the closest to that number, we're going to give you an Amazon gift card tomorrow. And YouTube saves the chat, so I can go through the chat tomorrow and make sure I get the right person. But if you get it exactly right, like if it ends at 204 and you literally know you did 204, just like DM me tomorrow on Twitter. Be like, yo, I definitely got it right. And I'll confirm, and then we'll get you a gift card. So let's see what happens. I have no clue. I think Amazon should be all right because AWS was good, because cloud was good for Google and Microsoft. So that's one reason I think it's okay. But the market, this is one of the worst days to report earnings. I mean, again, PayPal being green is exceptional. This is one of the worst days to report earnings ever. By the way, speaking of SoFi, I mean, like even if SoFi went up yesterday, it would have crashed back down today. So like, to me, it's not even a big deal that SoFi is down 15% over 2 days or 13% because it was going to be a day to take down every single stock in the market unless you had phenomenal earnings like PayPal. So really, if Amazon doesn't crush it, they're going to have a bad day. But if Amazon does crush it, then I think maybe they're able to withstand some of the momentum and pain that will end up happening for Amazon. I got to take off the blazer. I'm getting too sweaty, dude. We're in New Jersey right now. I'm like, I don't have the AC on. We're gonna have to take off the blazer and just go all black. By the way, while we're waiting for Amazon, we got 3 minutes until Amazon. I got to show you guys this. My back has been hurting all day. And when I mean hurting, I mean like I could not walk all day, dude. And the reason I could not walk is because I decided to be athletic yesterday, and I played a game of basketball. Dude, I haven't played street ball in 3 years. I don't know why yesterday I was like, oh, today's the day to play street ball. It's 70-degree weather. And these guys, yeah, they kicked my ass. And now a lot of people are like, how did you guys let people in slippers kick your ass? You guys don't understand, okay? Just because you're wearing slippers doesn't mean they're going to kick doesn't mean they're bad. Like, they were good. This tall guy was like fucking Shaquille O'Neal in his prime or something. It was ridiculous. And so, yeah, they kicked my ass and I lost 3 games back to back. It is what it is. But I woke up this morning and I was like, I can't move. I don't even know how I woke up for the PayPal earnings call. Like, I couldn't move. So we need Amazon to give us some momentum because it's been a rough day all around in terms of my ability to speak. You're short AF. Okay, yes, I am short, but still, dude, okay. The one thing about me in basketball, I know how to do a Euro step. For those that know basketball, it's a 2-step. It's a European 2-step. Manu Ginobili was the best at it, and I wasn't the best in those 3 games, but I had a string of a couple plays where I made like 4 shots in a row. Okay, maybe it was 2 shots in a row. I might be lying a little bit. It was 1 shot in a row. No, it was 2 shots. I promise it was 2 shots in a row, and I Euro stepped the shit out of these guys. And they were like, what the fuck is this guy on? Those were the 2 highlights of the day. And that made me keep my pride. But nonetheless, it was a tough day. So we need Amazon to recover this. Amazon's dumping right now. We have a minute left. It's down 2.5%. I don't know if that's someone got the news type of dump or if that's people are just scared type. Like, remember, NVIDIA dumped before earnings. People were scared, but then it mooned. So let's see what happens in the context of Amazon. All right, this is the last moment to get your bets in. $25 Amazon gift card to anyone who gets the exact price target or the closest within a couple percentage points to the price target. We'll see what people have to say, and we'll see where it goes. Is it 4 p.m.? All right, we have 20 seconds. I do ring a bell for those that are new here on the market close every single day, so just be ready for that to commemorate the stock market closing, and we'll see what happens. Did you wear the Kobe jersey? Nope. I was going to wear headphones, dude. I thought I was going to be cool and wear headphones and listen to music the whole time. And within 2 plays, I was like, let me take off these headphones, dude. I can't hear anything. I was really trying to be like a OG basketball player. And I was like, I haven't played in 5 years. I think I can play with headphones on. This is ridiculous. All right, 4 p.m. Tuesday, April 30th. The stock market is now closed. All right, here we go. So we're on our watch list. This is what we got, guys. Lemonade, Pinterest, SMCI, Starbucks, AMD, Amazon. I think Amazon might take a couple minutes too, because sometimes it takes a second before it officially loads up. Like, it takes till 4:05. And then we'll be listening to the Amazon call. As well. And we'll see how tough this ends up going, or how good it ends up going. It's dumping. Where is it? All right, we're down 1%. That's okay. That's not crazy. We're down 1%. Nothing insane. We're down 1%. We're down. Most people, I think, are, but what's the results of the poll? Okay, 70% say moon, 30% say dump. Remember, Amazon might increase their capital expenditure. That's been a big theme through earnings. Meta, all these guys increasing CapEx, but that's a good thing to me. So maybe the market will be bullish after, they increase their CapEx if they do. All right, we're green. We're green. Wow, 4%. Whoa. 4.34. Oh, no, it went back down. Went 1%. 1%. Well, wow, did you guys see that? It went up to 4, then it went right down to 1. Now it's at 2. It took the middle of 4 and 0. Oh, now it's red. Now it's red. Oh, boy. Oh, boy, now we're red. Oh, now we're dumping. Oh, boy. Now down 5%. Now down 5. Is that going to go back up to green? Is that just going to be... Look at that. It literally erased itself. Dude, this is bipolar. What the fuck is going on? What the hell is going on? This is insane. This is the most insane price action I've seen in a while. Let me try to get the numbers if they're out. The numbers have to be out. There's no way it makes a move like that if the numbers aren't out. Amazon numbers. I don't have the numbers yet on Twitter. Do I have them? Yes, I do. Yes, I do. Okay. 98 cents per share. They beat 83 cents. So they beat on EPS. Net sales 25.04 billion. They beat 24.1. They beat on EPS. They beat on the revenue, which is good. Stocks green. Stocks flat. Stocks flat. They beat on EPS. They beat on revenue. No other stocks are moving. AMD, Starbucks, SMCI, Pinterest, Lemonade. They're all flat. Okay, now it's green. Now we're getting some momentum. 3% up. Yeah, it should be going higher. It should be going higher. I mean, I don't see the whole earnings, but this is not horrible. This is not horrible. They beat on EPS. They beat on revenue. Yep, we're up 5%. Let's keep it going. Let's keep it going. Did they give a dividend? If they did a dividend, this thing might be mooning. Amazon, let's see. Let's try to get the deck. Let's try to get the deck. What do we got? What do we got? Let's also get on CNBC. Let's see if they have the numbers. They should have it by now. Do we have them? Do we have them? Yeah, we have them. We have some of them. We have some of them. Okay, here we go. Here we go. Let's get to it. Let's get to it. I'll keep updated in the chat, the price. Right now, prices, we're up 6%. Oh, we're up 6%. We're up 6%. Hold on, let me go back to this. Let me go back to this. It's actually going up. It's actually going up. We have some momentum. I'll go to CNBC in a second. 6%, not bad. We are $2 away from all-time high. $2 away from all-time high. $2 away from all. I know now it's dumping a little bit. Wow, the street's really scared of this one. They're just not letting it move. It's going up and down, up and down. All right, let's go to CNBC. Let's see what they have to say. Really interesting price action here. Here we go.
This morning.
Yeah, I just want to mention,
a toxic combination of economic data today with the hot inflation side.
Of 98 cents. That was a beat. Street was looking for 83 cents from Amazon. That was on revenue of 143 billion, better than expected. Wall Street consensus was 142 billion. We are still looking through the results, but that's the initial reaction. You can see stocks pretty much unchanged here, slightly higher after hours, John, but we will keep looking through these results here, especially for that AWS number. We'll come right back with some details.
All right. Sometimes it's like big goods, Mike Santoli. You got to let it settle a little bit. It was down 4% initially, but then popped back up to even, and now it's up 3.5%. We haven't even had the earnings call yet. Mike Santoli, I'll go to you on this one. There were big expectations out of Amazon.
All right, let me go to some other stuff we got going on right now. Let's go to some of the other stocks. Amazon it's struggling to keep its gain, but it's up 5%. Granted, we were at this price action a week ago, so this is not phenomenal, but it is good. But it's definitely not Google bursting through the 160s, right, and then piling into the 170s. SMCI is up 3%. I'm really curious about these guys. Let me get SMCI. So that was Amazon. They beat on EPS. They beat on revenue. Trying to get some more updates. Their deck is not out yet. Is their deck out? No. Quarterly results? Not out yet. Not out yet. So we're still waiting for the deck. SMCI. SMCI, the numbers are not out for SMCI either. So it's going up, but there's no numbers. Going up, but no numbers. No numbers for SMCI. Starbucks, yeah, I'll try to get Starbucks as well. Let's see what we got on Starbucks. No numbers on SMCI. Starbucks, the China stuff is really interesting for Starbucks. Oh, 17% year-over-year growth for Amazon. 17%. Revenue on Amazon, 143 versus 142 billion. So they beat by almost 800 million bucks, close to $1 billion, which is not bad. Starbucks numbers are not out either. SMCI now is up 7%. Wow, SMCI is mooning. SMCI is mooning. Starbucks is down 7%. Oh, wow. Starbucks down 7%, SMCI up 5%. Amazon maintaining 4%. AMD is up 1%. That's nice to see. AMD getting a little bit of momentum. Starbucks is tanking. It has to be something China related, I would imagine. Let me try to pull them up. Starbucks. Let's see if we got Starbucks information. SMCI is up 6%. Yeah, SMCI is up. SMCI looks like it. Okay, here we go. Do we have Starbucks? Do we have it? Press releases, financial releases, 2024. No, not out yet. Events and presentations. No, still not there. All right, let's go to CNBC. Maybe they have some numbers on other companies. Okay, they're still doing Amazon updates. Let's hear a little bit on Amazon. I'm trying to get all the rest of the numbers. They're still not out yet, but we'll let this play and then I'll get the rest of the numbers. Amazon is up. Here we go.
We're optimistic on the story about what they can do with margins. Obviously, AWS kicking back in, reaccelerating in terms of growth rate. So all that seems to be baked into what the street was expecting. You also had estimates up quite a bit over the past few months. So, the past quarter, they definitely hurdled that. In terms of what revenue guidance looks like, I think that's where a lot of the focus might set.
Real quick on Starbucks. So they missed EPS by 11 cents, 68 cents versus 79. And they missed sales by $1 billion, or not $1 billion, about 600 million, 8.6 versus 9.1 billion. So they missed on both top and bottom. That's why they're down right now.
Settle in from here.
Yeah, along those lines, Adam, North America segment sales for Amazon up 12% year over year, 86.3 billion. International segment up 10%, increased 11% ex foreign exchange rate impact. AWS, this is the big one, right? AWS segment sales increased 17% year.
That's great. That's good. That's good growth for AWS.
Over year to $25 billion. That looks like it's a little better than street expectations. It's interesting to see that after Alphabet beat with its cloud, Microsoft beat with Azure with its cloud business this quarter as well. It really speaks to
All right, I have SMCI. SMCI is up 10%. Is it up 10%? Where is it at right now? It's up 5%. It's up 6%. Oh, Pinterest is up 21%. Holy crap. All right, let's do SMCI, then we'll do Pinterest. Let's do SMCI. 3.85 billion on revenue. That's up 201%. That's good. Gross margin of 15.5%. They increased gross margins by 100 basis points. Net income of 402 million, so they're still profitable. Diluted net income a share 656. That's fine. Cash flow about 1.5 billion. That's fine. 15.6 non-GAAP gross margin. That's good. That's higher than it was before. CEO says we had another record quarter with 3.85 billion. This year-over-year revenue growth of 200%. Not bad. Again, margins, not software margins, but still not bad growth. And year-over-year non-GAAP EPS growth of 308% was well above our industry peers. Strong demand for AI rack scale PnP solutions, along with our team's ability to deeply innovate DLC designs, enables us to expand our market leadership in AI infrastructure. This is good for NVIDIA. Is NVIDIA up right now? Starbucks did have a big miss. That is correct. Starbucks had a big miss. So Pinterest is up 22%. Starbucks is down 7%. AMD's flat. Amazon's up 5%. SMCI is flat, guys. SMCI is about to go red. Oh my God. Wow, dude. Where's NVIDIA? I think NVIDIA might be flat too. NVIDIA's slightly green. AMD, again, we just saw. I'm going to pull up AMD's numbers in a second. SMCI just gave up their gains, dude. Wow. Huh. Now it's up 3%. It's like nothing's holding. Wow. Starbucks down 8% now. I'm trying to pull up Starbucks numbers. So SMCI released their stuff. Starbucks, I want to see the press release. Let's see if we can get it here. To Starbucks credit, they do have a nice PDF every time they announce their. I know that doesn't change everything, but still, it's like it looks nice. Okay, here we go. I think I got it. Okay, here we go. Here's Starbucks. We'll do Pinterest in a second. Starbucks. Revenue's up 8% to 9.4. No. This is the wrong one. Oh, they're giving me December. This is the wrong one. We're in 2024 and these companies can't link to the right. It's unbelievable. It's unbelievable. Let me go back to CNBC. I'll pull everything up. Let's see if they're covering Pinterest because we need some coverage there. They're still talking about Amazon. Okay, we'll go back to Amazon for a little bit and then I'll get Pinterest. Here we go.
These expectations don't take Forex into account.
No, definitely. And I'm just looking at the report. So the North American retail operating margin of 5.8% is very healthy. So that's above expectations too. The street was about closer to 5%, and that's down just 30 bips sequentially. So like I said, outperformance in AWS, outperformance on North American retail operating margins. Those are really the two key drivers of this story. And yeah, there's some switches in the guidance that could be FX related. We'll probably get some more color on the call about various pieces of their business, but for Q1 at least, they're still performing very well.
Mike, I mean, we look at.
I think I have Pinterest. Is this the right one? Is this the right one? Yes, I have the right one. Here we go. Here's Pinterest. Here we go. This is why Pinterest is up 20%. Let me know if anyone has Pinterest. Revenue of $740 million, up 23%. Not bad. Not bad at all. More than 500 million MAUs. They passed 500 million. There you go. Record 518 million MAUs, an increase of 12%. Yeah, they were below 500 last year this time. That's incredible. That's great for Pinterest. There's a lot of 40-year-old women that are using this product. There's a lot of them. Q1 revenue grew 23% year over year to 740 million. MAUs increased 12% year over year to 518. Net loss, they only lost 25 million. Look at that. Last year, I think they lost like 80 million or something. So that's a great decrease in terms of the net lost. SMCI is down 5%. Yeah, I don't know. I don't know about that one. I mean, maybe the street's looking at the margins and they're not impressed, even though the revenue's up there. But that one is down. Oh, wow. SMCI is getting hit. Oh my God, dude. It's down 6%. Okay, I'll read a little bit more, then we'll get to SMCI. CEO says, Q1 was a milestone quarter for Pinterest. We reached a new high, surpassing 500 million MAUs. Our fastest user and revenue growth. Thanks to our investments in AI and shoppability, we're driving greater returns for advertisers and gaining access to performance budgets. Okay, so nothing too crazy. US and Canada, 592. Europe, 118 million. Rest of the world, 30 million. So most of their revenue is coming from US and Canada, 592 million people that are using this product. Again, I don't use Pinterest too much. I do think it's a phenomenal product. I have used it in the past. I'm not an active user of it. But from a shopping perspective, advertisers must love it because the intent when you go to Pinterest is to buy. And honestly, women love, women shop the most. And so if a lot of women are using the product, it's a very profitable a segmentation of demographics to be able to use. So Pinterest up 21%, SMCI down 3%, Starbucks down almost 9%, Amazon barely keeping momentum. And it's getting hit. Garcia says, I asked my Gen Z sister-in-law what app she would use if TikTok got banned. Pinterest does have a vertical video feed. It's not the most entertaining, but they do have a vertical video feed, just like a lot of these apps. So it is popular around a lot of people. That's why I could see it being up 20% off good numbers. It had been sold off for the majority of the past year. SMCI is down now. It's kind of recovering. This is a very weird earnings, guys. So far in Q4, every company would go up and down almost like automatically, right? Every stock. This earnings has been pretty, like if a stock went up, if it was green within the first 2 minutes, it would stay green, even if it wouldn't be super green. These earnings today have been pretty lopsided. Unless you have a Pinterest type of beat, you're not going to maintain some of that momentum. Okay, AMD. We haven't even talked about AMD, dude. AMD is one of the biggest companies today. We haven't even talked about them. Let me pull them up. And we'll start with them. Amazon's call, by the way. Let me just make sure we have this right. Amazon quarterly. That's, I believe, at 5 p.m. We should be good on that. Amazon earnings call. So that's about 40 minutes from now. So we should be okay. What time is it? 5:30. Okay, 5:30. Okay, so we actually have time. We actually have a decent amount of time to see. Okay, AMD. That's what we got to get to. Wow, how's it not on the website yet, dude? What? How's it not on the website? AMD news and events. Do they do like 420? Do they usually do it later? Yeah. Does anyone have AMD? I don't have AMD. Maybe this price action on AMD is garbage. It's not real because I don't have it. Let me check Twitter. Does Twitter have it? I don't think Twitter has. I don't think we've seen AMD happen yet. Yeah, we haven't seen AMD happen yet. Yeah, it's 420 or sorry, 415. I think we have a minute. Wow, so we haven't even seen AMD price action. We haven't even seen it. Oh boy. Okay, so AMD is the net. Let's see if AMD. So for those that didn't pay, we're dumping. There you go. We're dumping. Not crazy, but we're dumping. AMD lowered guidance in Q4 for Q1 to flat or negative growth across every segment. So I didn't have high expectations going into AMD. We're down 4% right now. But maybe that doesn't hold up if they beat on some of the numbers because they already lowered expectations so aggressively that maybe if they announce something exciting, the market gives them momentum. It's trying to sell. It's trying to buy up a little bit. People buying the dip as it went down 4%. Now it's down 2%. Let's see if CNBC has the numbers for AMD. Okay, they have SMCI. Let me listen to them on SMCI, and then they'll probably get to AMD in a second. So let's listen to SMCI, then we'll get to AMD.
Guidance. But let's go through the Q3 results. EPS was a beat at $6.65 adjusted, with revenue fell short $3.85 billion. But what we're seeing for Q4 revenue guidance, a range of 5.1 to 5.83 billion. So that is a little bit, or I should say about around 5.1 billion. That's a little bit higher, but the
Okay, I have AMD. Here we go. We'll go back to CNBC in a second. All right, so AMD, one of the most important companies in the world when it comes to AI, semiconductors, etc. Here we go. 5.5 billion. This is what they said. Nothing too crazy. I think it's slightly higher than what we were expecting. Let me give you the expectations real quick. AMD's expectations were, we were expecting revenue of 5.1, so that's a $400 million beat, and EPS of 57 cents. So I think they beat on the top and bottom line. Okay, so 5.5 billion, 36 million operating income, net income of 123 million. Diluted earnings per share was 7 cents. That's fine. Operating income was 1.1 billion. EPS 0.6. So they beat by about 4 cents on EPS, and they beat by 400 million on revenue. So top and bottom line, they did beat. Webull has them down 3%. They're down 3%. Okay, Lisa Su. We delivered strong first quarter results with our data center and client segmentations reaching each growing more than 80% year over year, driven by ramp of our M1300 AI accelerator shipments and the adoption of our Ryzen and EPYC processors. This is an incredibly exciting time for the industry as a widespread deployment of AI is driving demand for significantly more compute across a broad range of markets. We are executing very well as we ramp our data center business and enable AI capabilities across our product portfolio. Okay, that's great. As you can see, Q1 last year, they did 5. Oh, wow. Year over year growth is 2%, dude. That's not a ton of growth. I mean, we already knew that was going to be like that, but that's not a ton of growth on revenue. Now, Q1 always tends to be a little bad. Look at that. Quarter over quarter, it's down 11%. Gross profit down 12%. Wow. Look at the quarter over quarters. Down, down, flat, flat, down, 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 down. That's like you can make a cheer out of that if you're like a cheerleader, dude. It's like down, down, flat on gross margins, flat on operating expenses, down operating income, down on operating margin. It is Q1 that tends to happen. And then down on net income, 82%. Goodness gracious. They made 667 million in Q4. They're making 123 million in Q1. And then EPS is down 83% as well. It just shows you the cyclicality of the business, right? Q4, these numbers are incredible. Q1, these numbers are like not incredible, you know? It's like actually pretty bad. Yeah, AMD's down 5%. Oh boy, Starbucks is down 10%. Oh my God, they're getting hit. They're getting hit. Let me look at the earnings call. Is there anything else? Record data segment revenue, data center revenue, 2.3 billion. So that's good. Data centers are up. Gaming was 922 million, down 48% year over year. Client segment revenue was 1.4 billion, up 85% year over year. And then segmented revenue was 846 million, down 46% year over year. All the other highlights, I mean, these aren't that important. At the end of the day, the numbers just aren't the best. If you're long AMD, this is the dip I think most people wanted. I mean, tomorrow, look, if this holds up, then maybe we see the 140s on this. Starbucks down 10% at $79. There is a dividend of 3% on Starbucks, 2.58. So, maybe that dip looks a little exciting. Pinterest now is down 4%. It was up 20%. Now it's down up 16%. So sold off a little bit. SMCI down 1%. Look at Amazon, dude. Amazon's barely holding. Goodness gracious. Amazon's barely holding. Amazon is disgusting, bro. What is this? What is this? Okay, can I pull up Amazon's IR? I didn't even get a chance to pull up their thing. Okay, here it is. Here's Amazon. I got it. Here's Amazon. Let's look at Amazon. Q4 is typically stronger for tech companies. That is correct. Did anyone get where's Amazon right now? Amazon is 180. All right, so we'll see in the next couple hours how it ends, and I'll see in the comments if anyone got it exactly correct. I don't know if someone guessed 180 because that's basically flat, which is, I think all of us thought there would be a move to the upside or downside. That was a bit more extreme. So net sales, 13% up year over year, 143 billion. AWS was up 17%, so that's great. International sales up 10%. North America up 12%. Overall, they're growing. That's good. I mean, compounding off of 127 billion is not easy, dude. So that is growing. Operating income, 15.3 billion compared with 4.8 billion. That's incredible. That's up 300% roundabout. Not bad at all. AWS, as you can see, it was the majority of this at 9.4 billion. That's probably what's contributing most of their net income. Look at this. Net income was 10.4 billion. So they did $15.3 billion of operating income, $10.4 billion of net income, which is like their actual profits, and then $143 billion of revenue. So this is the thing about Amazon. Most of their revenue at the end of the day does not go down to the bottom line because the margins on, you know, the water bottles and everything they sell in the store is not the best. However, AWS is what keeps this business alive and is what gives people so much hope, even with the high PE, because AWS is a monster and they're a market leader. And that's growing well. 17% year over year is incredible on that. So that's not bad. Free cash flow, $50 billion over trailing 12 months, $3.3 billion. Outflows, free cash flow, less principal repayments. That's $46 billion. Highlights, continue to delight customers with fast and convenient delivery. More than 2 billion customers, no more than 2 billion global units arriving the same day or in Q1. Let me know if you've had next day delivery, because I've had next day delivery and it's pretty incredible. So that's amazing. Where's Bitcoin? You guys think Bitcoin's tanking? SMCI's down. Where's Bitcoin? How bad is Bitcoin? Wow. Bitcoin might go to 58,000. Oh boy. All right. Expanded the company's healthcare offerings, launched the grocery subscription. I don't know if you guys remember that story, but you know that Amazon Go where you walk into a store and you buy something and you just leave the store? That wasn't AI. That was people like in India tracking what you were buying and then manually entering it. So Amazon got rid of that at Whole Foods. That's hilarious when that story came out. AI is not that good yet. And I always thought it was kind of magical. Like you could just walk in, pick up a can of Celsius and then leave, and then you just get charged automatically. Like that's some pretty sophisticated AI. Yeah, we're not there yet. Prime Video will stream its first NFL wild card playoff game in January 2025. Prime Video is doing well. They did increase the subscription by $3 unless you want the ads. I don't watch anything on Prime. There's just nothing there for me. So let me know in the chat if you guys watch Prime. But Prime is like nothing that is interesting to me, but a lot of people do watch it. And I still pay for Prime. So even if I don't watch it, right, I still pay for it. Yeah, a bunch of different highlights, nothing too crazy. Plans to launch new infrastructure regions in the Kingdom of Saudi Arabia and in Mexico. So they're going to launch some data centers and AWS infrastructure in two really big growing parts of the world. Mexico exports to the United States are up 23%, which is more than China on the trailing 12 months. Incredible. And then Saudi Arabia, there's just so much money. The prince there wants to revolutionize the entire kingdom. So it makes sense that Amazon wants to have a growing presence there as well. Not bad at all. By the way, I was talking to someone who lives in the Middle East the other day, and you know we were just talking, just like we met over the internet and wanted to have a conversation about different, basically ideas that are in the Middle East in terms of growth and comparing that to the United States. And I asked him a really important question because he's lived basically 20 years in the Middle East, the Qatar, Kuwait type of region, right? And I said, hey, if someone comes up with the next Google in Saudi Arabia, would the prince ever cut his head off? Like, would they do a Jack Ma, which is what they did in China? And he said, unequivocally, I can guarantee you that will not happen. And the reason he said that is because there's so much energy in the Middle East. There's so much dynamism. There's so much money. Like the king, they have Saudi Aramco. I found this out 2 weeks ago. I was flabbergasted. I cannot believe this. It was the first company to IPO at $1.87 trillion. I didn't think we had a $1 trillion IPO. Saudi Aramco was a $1 trillion IPO. And when I brought that up, he was telling me, dude, Saudi Aramco is nothing. Like the amount of money that's in the Middle East that's waiting to fund tech. That's why Sam Altman is taking his ass over to Dubai to try to get $7 trillion to build an NVIDIA competitor. Like there is so much money. And so he basically was saying, look, if you build the next Google in Saudi Arabia, they're not going to Jack Ma you. They're going to encourage you. And so there's a lot of money there. It makes sense that Amazon wants to expand there. They aren't a full democracy, but they're a bit more liberal than even, the CCP and in Russia. So seems like entrepreneurship will thrive there. SMCI down 1%, Starbucks down 9.6%, AMD down 3%, Amazon is up 3%. Amit, did you use a hair straightener today? I did not. That's just my hair without wearing a hat. Let's go back to CNBC. Let's get their coverage as well on AMD. I'm assuming we have a report there for AMD. AMD, do we have something yet? No. All right, let's get SMCI. They'll get to AMD in a second. Let's do SMCI.
The company also saying they're raising their full year 2024 from a 14.5 range to 14.7 billion to 15.1 billion. So not only are they increasing their Q4 revenue guidance, the full year goes up with it. And they're saying they're seeing strong demand across the board, especially for their AI servers, which is what they assemble. So you can see the stock reacting to that guidance. Thank you.
Yeah, it looks like we've just turned lower actually for Supermicro, down about 2%. Christina Partsinevelos, thank you. Starbucks, another one trading lower right now in overtime. Those earnings are out. Steve Kovac has the numbers.
Hey, Morgan. Yeah, and shares are down about 8% after missing on the top and bottom line. We got EPS coming at 68 cents. Street was looking for 79 cents. and revenues were $8.56 billion. Street was looking for $9.13 billion. And even some more bad news in this report. Same-store sales are down 4% and also a 6% drop in transactions. Guidance, nothing in the release on guidance. That's coming on the call a bit later, Morgan.
Okay. Steve Kovac, thank you. Ad, I'm going to go back to you. It's sort of like pick your poison here. I know the bar was very high for Supermicro going into this, maybe not so much for Pinterest, but the commentary there about
AWS's AI capabilities, he said that was reaccelerating AWS's growth rate, says AWS now at $100 billion annual revenue run rate, ARR, talks about delivery speed, and then the lower cost to serve advertising. We haven't gotten to that number yet. That was up 24%, better than expected, a high margin part of the business. Folks are watching. And then on profitability, free cash flow improved to an inflow of about $50 billion, $50.1 billion, compared to an outflow of $3.3 billion a year ago. So that profitability picture improving. North American margins finally 5.8%. Those shrunk slightly from 6% sequentially, but it was a massive expansion from what was about 1% a year ago. So better profitability picture here for Amazon. John and Morgan, back over to you.
Okay, Kate Rooney, thank you. Shares are up about 2.5% right now. For more on Amazon, let's bring in Gil Luria of D.A. Davidson and Maxim Group.
Let's listen to a little bit more about Amazon. I'm trying to pull up some AMD stuff, guys, and then we'll talk more about them. The call is in an hour, so we have some time. And so we'll talk about this, and then we'll talk Pinterest as well. AMD's numbers were flat and are down across the board. They did beat on EPS and revenue, but slight beats, which is why the stock is down 2%. Amazon's struggling to be up 3% right now.
Group's Tom Forte. Great to have you both here. Gil, I'll start with you. Your initial reaction, especially when we saw so many of the key metrics come in better than expected, starting with perhaps AWS.
That's by far the most important number here. Not only is that 17% a lot better than expected, it's more acceleration than Azure and GCP had last week. I can't overemphasize that. They're accelerating faster than Google and Microsoft, who are always in the AI debate. That makes it look like AWS is now catching up on AI and perhaps in a position to lead. Let's not forget their business is a lot bigger than Azure and GCP. Their foundation is from chips to the SageMaker foundation model to Bedrock facilitating other models to Amazon Q, which they announced today, which does a lot of things for enterprise that every other software company is trying. And now Amazon is telling them, no, don't worry about it. We're going to do this for the enterprise. So that's a very important result. Everything else almost pales in comparison.
Tom, what to make of the broader profitability picture? And I ask that knowing we got those North American margins that came in stronger than expected. And as Adam Christofouli was telling us, that's such a key metric to look at. Free cash flow also improving, more than $50 billion there. And then the high margin advertising business coming in strong too, at a time where we know Amazon and all of its peers in the mega tech cap space are pouring so much money into generative AI and these new AI applications. The fact that they are coming in with better profit numbers tells us what?
It tells us that Andy Jassy's emphasis of services for Amazon is working. And when you couple that with his very aggressive expense management, you're seeing these impressive margins. So in addition to Gil's comments on the strength of AWS, you saw the strength of advertising, and you're seeing the benefits for North American retail of the aggressive cost-cutting moves by Andy Jassy. So I think that that's what you're seeing across the board, an emphasis on higher margin services and aggressive expense management, resulting in very impressive margins and profitability for Amazon.
Gil, do we have to revisit the narratives here? And I hate how stock price moves can sometimes end up equaling truth for people, at least for a period of time. But the narrative for a little more than a year has been Amazon's behind in AI because, in part, Microsoft's partnered up with OpenAI, et cetera. Google was supposed to be behind too, but now people don't think that anymore because the stock went up. Okay, Amazon seems to have intentionally released Q on the same day as earnings, perhaps driving home something about the cloud growth and the AI strategy behind it. So what should investors take away from that?
Yeah, that's exactly right. That
They should take away that Jassy is not fucking around, dude. Jassy is not messing around. Amazon, I think, has one of the best AI visions over the next decade, but the street right now not showing them a ton of love.
may not have been as ahead of the game as Microsoft was. Let's not forget, Microsoft was well ahead of the game. GitHub Copilot came out in July 2021. We didn't even know about ChatGPT back then. Microsoft did an incredible job of capturing that value and continuing to run with the lead. But Amazon stepped back last year and said, well, what do we want to do? We want to build a whole infrastructure for our enterprise customers. We're not going to be as worried about consumers and consumer applications. We're going to develop the whole infrastructure so our existing AWS customers can execute on what they want to do with generative AI. And that's what we're seeing today. And let's not forget another very important piece that we can now piece together between the three results. It's not just AI that's driving acceleration for the hyperscalers. Both Microsoft, Google, and now Amazon have accelerating growth beyond the contribution of AI. For Microsoft, it was 2 points of acceleration excluding AI. For Google, it was the same. And I would imagine that a jump from 13% to 17% growth for AWS, which again is a $100 billion business, has to do with enterprise spending on cloud easing up.
Right.
That's good news for Amazon. It's good news for the rest of the market as well.
Tom Forte, I worry that investors might be paying attention to the wrong headlines because, you know, I know, Gil, you mentioned how the narrative has shifted. Amazon's done some things, but these strategies don't change that much in a year. They've been planning their AI stuff for a while. So, Tom, as we get into more of these developer conferences that are coming, starting in the summer, going through the fall, is it more the developer announcements? Is it the kind of partner and industry verticals for AI and cloud that matter more? What's really going to move the needle for these companies in monetizing cloud and AI at this phase?
Sure. So I still think when you think about artificial intelligence, it has a huge benefit to the chips providers. Think of NVIDIA. And now, as Gil pointed out, and what we're seeing, a huge benefit to the hyperscale cloud companies and a lesser benefit kind of to everyone else. So it's good to see that you had the renewed growth in AWS. You're seeing now that AI is, in fact, driving growth in AWS. Last year, you saw that cloud computing was more cyclical than secular. So I think that as we have more quarters here where we're seeing that AI is driving revenue for AWS, and then Amazon can also benefit at the retail level using AI, including at the expense management level. So I think all these things are beneficial for the next 12 months for Amazon shares.
All right. Gil Luria, Tom.
All right, that's some coverage on Amazon. Let me see if, Chris, I know you're in the chat. If you can pick up, I'm calling you real quick. We can get 5 minutes of your thoughts, then we'll get some more coverage. I know Chris does have an Amazon position, and he is bullish on this company. We'll be talking about it tonight on Finance Junkies as well, and discussing their earnings. SMCI right now, AMD is down 3.6%, Amazon's up 2.6%, Starbucks down 10%, dude. Pinterest still up 18%. Starbucks is not getting any love. All right, Chris said he's out. All right, so Chris can't pick up. Okay, no worries. Elon posted about the supercharger. Okay, what did Elon post about? What did Elon Musk post about? Let's see. What did Elon say? Elon. Okay, here we go. We got a tweet from Elon. We got coverage from Elon. Tesla still plans to grow the supercharger network, just at a slower pace for new locations and more focus on 100% uptime and expansion of existing locations. Okay, that's fine. Shouldn't be too bad. I mean, Tesla stock right now down another 1% after hours. Again, the whole market's kind of red. I think someone said it best in the chat. Everyone is getting scared of Papa Powell tomorrow and what the hell this guy's going to do. Everyone's getting scared of them. And as a result of that, I mean, Amazon should be up like 10%, dude, or at least up 5%, dude. Up 2% is like nothing. Like it's like the buyers are, it's like the people that are buying the dip are buying it to people that are ready to sell immediately because I think they're afraid of what Powell's going to say. And I don't think he's going to be relatively hawkish tomorrow. I think he's going to be normal. He's going to be data driven and say the same stuff he's going to say. But that I think has the market very, very upset and scared right now. Amazon up 2%. Let's get some coverage on Pinterest as well, because Pinterest had a okay earnings. So I want to get a little bit on them. And then we'll talk more Starbucks and try to see what's going on there with Starbucks. Let me pull up. Oh no, we have AMD. We have AMD. Let's do AMD results. Let's do AMD. Then we'll go to Starbucks. Okay, here we go. Let's talk AMD. Then we'll move on.
Analyst John Vin. John, the results and the guide just about in line. People were hoping for a bit more, but is this enough?
Not in the near term, but we certainly think that there are some encouraging signs in the results. Both the PC as well as the data center segments upsided in the quarter, and that was really what most investors are focused on. Obviously, shares are down 3%. I think that's because the implied EPS guidance is slightly below consensus. Looks like it's coming in at 66 cents, and consensus around 70 cents for 2Q.
So is this a calming down, perhaps, of some of the excitement around how soon AI was going to deliver results? Supermicro, which packaged in the chips from NVIDIA and others, also down, but slightly on its results, down about 1.5% at the moment in overtime.
I don't think this is indicative of the broader AI market. I think you have to keep into perspective that AMD is an emerging player in AI. Their market share last year is going from 0 to, we think a pretty significant number this year. So they're still ramping their MI300X AI GPU this year, and it's still very early days for AMD.
How much do gross margins matter here? And I ask because it looks like they came in slightly better than expected for the quarter. They're guiding for slightly better in the next quarter. And this is certainly a key part of the story for an AMD as well, especially with the stock up as much as it is this year.
Gross margins matter a lot. I think a couple of things are benefiting them in the near term. We think obviously they're starting to ship their AI GPUs, and that's accretive to their gross margins on the quarter and the guide. I think there's a much more meaningful upside on gross margins as you go into the second half of the year, because you're going to see AI GPUs become a much more meaningful percentage of their mix. And then you should start to see some of that embedded cyclical business start to come back in the second half. And those are probably some of the highest gross margins in the business right now.
Okay. John Vin, thanks for joining us.
Thanks for having me.
Shares of AMD under.
All right, we got some news on Elon. We got some news on Elon. We'll talk about Starbucks in a second. Again, the AMD stuff, we already knew the news was going to be bad. We knew their expectations weren't good. So not that surprising there. If you're long AMD, you believe in the data center story, the GPU story, the CPU story, it's probably going to be a buy the dip for most longs. Down 4% right now. Elon Musk has responded to why he unfollowed Sawyer Merritt. For those that don't know who Sawyer Merritt is, he is one of the biggest Tesla accounts on X, which is Elon's platform. He just answered. Elon said, someone says, curious, Elon, why unfollow Sawyer? I suspect he breaks more news on Tesla than what employees are telling you half the time. Elon says, don't post leaks of confidential information and expect me to follow. Wow. That's pretty aggressive. But that's what he did say. There you go. That's what we got on Elon. Okay, let me guys ask you a question. Is SMCI starting right now? Do you guys want to listen to SMCI while we're waiting for Amazon? Because we can either just do analysis and keep looking at stuff, or we can pull up SMCI. Did they start right now? They started. Did they start? Let me make sure. No, they're starting at 5, guys. They're starting at 5. So we can't even start right now. Yeah, we got to do AMD. I think we can do SMCI for 30 minutes if you guys want. All right, here's the question. Do you want SMCI from 5 to 5:30 and then 5:30 we swoop to Amazon? Or do you not even want to be given those 30 minutes for SMCI? Because SMCI, yes. All right, so it's going to be 30 minutes, then we're going to Amazon. 30 minutes, then we're going to Amazon. If that's what everyone wants. If not, then we can just keep talking. Okay, SMCI is at 5. It's not right now, so we're going to have to wait 20 minutes, and then we'll go there. The first 30 minutes should be the most important of SMCI also, hopefully. Hopefully it doesn't take forever, and then we'll go to Amazon. Okay, cool. I think more people want SMCI over that, so we'll do SMCI. I haven't heard from the CEO ever, so let me see what the CEO has to say. Maybe there's anything interesting. So this is really interesting. Elon says, don't post confidential information and expect me to follow. Elon says, guys, Sawyer Merritt, I don't know if you guys know this guy. This guy's a pretty big dude in the community. Look at this. Almost 650,000 or more than 650,000 followers. He's a big Tesla guy. I wonder, it's kind of like, you know what this is, dude? It reminds me of Neil Armstrong like getting mad at Elon for trying to go to the moon or building SpaceX. Do you remember that scene where Elon was crying because of that? Because like they asked him how does he feel about like his heroes, and then Elon was Elon started, dude, I was emotional when I said Elon was literally crying, dude. Elon was like, it's sad that they don't get it. If I was Sawyer, I would be crying. I would be like, dude, did the guy I worship just say that? Like, really? Like, that would suck, dude. I'm not gonna lie. That would suck. That would be sad. I don't think Sawyer's a bad account. You guys think he's a grifter. I've seen him sell a course or anything like that. I think he just posts news updates. That's what I've never thought of him as a bad account. I was in some beef with Sawyer. Oh, Lemonade's up 11%. I was in some beef with Sawyer once because after the Tesla earnings call, I said, oh, Elon said Dojo is like probably not happening. And I tweeted that. And then he quote tweeted me and he was like, this guy's wrong. And I was like, Brody, if you're going to tweet me to 600,000 people, I'm going to give you the smoke. Fuck out. Like, I'm not taking that. I'm not like, he was trying to dunk on me. I'm like, you're not going to dunk on me, my guy. Like, I don't care how many followers you got. So I pushed back and I was like, actually, and then I wrote a long essay and then he responded with a bad response. And then that was it. But like, I stepped up to the challenge. I wasn't going to let a big account bully me. I wasn't going to let that happen. Like I had to go for his neck, dude. You're not gonna fucking do that to me. Nonetheless, I think that is interesting that Elon's just like screwed this guy. Pinterest up 18%, Lemonade up 8%. Let's get some coverage on Pinterest. I want to get some coverage on Pinterest because the Pinterest move is pretty spectacular. I mean, if you have calls on Pinterest, then you should be in a great situation right now if this maintains itself. Let's see. And then I want to pull up Starbucks as well. Where is Pinterest? We're going to pull up Pinterest in just a second. It should be here. Or actually, let's do Starbucks. Okay, a little bit more on Starbucks. Here we go. Caesars Entertainment also had earnings today. Caesars Entertainment had earnings today. Here, let's do Starbucks, and then we'll keep going.
Skyworks, how much we should read through to Apple with that stock trading lower?
The by far the leading response to where might you start to spend less was eating out of away from home. Now they always say that, but I think maybe they might mean it this time. Aside from that, relatively messy responses. I still think things like Pinterest being up 20%, even though I get it, it's an upside surprise. It's a nice little story in terms of their earnings growth picture coming into view. It's just an erratic reaction to one of these reports, and it shows you this is a market that is suffering from kind of lower conviction, and basically prices have to move really far to find people with a confident take on these stocks.
All right, Mike, we'll see you shortly.
I finally got Starbucks. They finally posted it. Kyle's, what's up? Thanks for being here in the chat. Oh, Kendrick's Dip, by the way, or Kendrick. Did I say Kendrick's Dick? I'm sorry. I said Kendrick's Dip because I was thinking of stocks dip. I hope it didn't sound like dick, but Kendrick's diss, for those that are hip hop fans, it came out. It was not good. It was not good. It was a bad diss. I don't know who's a hip hop aficionado here, but the diss was not good, dude. I thought it was really bad. I mean, he was just rapping. Drake actually made a diss song that was memorable. So I didn't like it. I didn't enjoy it. Okay. Starbucks reports Q2 fiscal results. Net revenue down 2% year over year, $8.6 billion. $8.6 billion. GAAP EPS or non-GAAP EPS of 68 cents. Again, the street wanted about 80 cents there. So that's not the best. Rewards membership total 32.8 million. So about 33 million people are Starbucks rewards members. Let me know in the chat. Do you have a Starbucks reward? Or are you a Starbucks member? I think I have the app, but I'm not really a member because I don't go to Starbucks that much. But 33 million people, not crazy, dude. That's like that's like a subscription to a Paramount. Paramount's at 70 million, but in their first year they did 32 million. Sirius XM has 34 million paid subscribers. So the fact that 33 million people are on Starbucks is not that crazy. Global comparable store sales declined 4%, driven by a 6% decline in comparable transactions. North America and US comparable store sales declined 3%, driven by a 7% decline in comparable transactions. Wow. Did an international this is the bad one. Wow, look at this. China comparable store sales declined 11%. Oh my goodness. China is not going well. 11% year over year. That's not supposed to be happening. And that speaks to the state of the Chinese consumer. If the Chinese consumer can't get a caramel macchiato, that means there's an issue in China. Maybe that speaks more to China than Starbucks, unless there's some internal problems with Starbucks. At the end of Q2, stores in US and China comprised 61% of the company's global portfolio, with 16,000 stores in the US and 7,000 in China. 38,000 stores worldwide. 52% are company operated. 48% are licensed basically as franchises. And CEO says, in a highly challenged environment, this quarter's results do not reflect the power of our brand, our capabilities, or the opportunities ahead. It did not meet our expectations, but we understand the specific challenges and opportunities immediately in front of us. We have a clear plan to execute, and the entire organization is mobilized around it. We are very confident in our long-term and know the triple shot reinvention with 2-pump strategy. What the fuck will deliver on the limitless potential? Is this a metaphor? Is this a metaphor? We know our triple shot reinvention with 2-pump strategy. Is that a real thing or is that a metaphor? Like, is that if that's a metaphor, I like that. That's a CEO that I like. That's a dope little metaphor to put there. But if that's like a real thing, is the 2-pump strategy like a real way to drive sales? While it was a difficult quarter, we learned from our own underperformance and sharpened our focus with a comprehensive roadmap, our well thought out actions, making the path forward clear. Oh my. Okay, let's go back to the chart and see what's going on. SMCI is crashing. Oh boy. SMCI is down 8%. Starbucks is still down 10%. SMCI is down 8%. SMCI, their numbers weren't insane. 200% year-over-year growth, gross margins up 100 basis points. So nothing insane, but definitely, I don't know if it warrants a 10% decline unless the market's feeling like they're topping out. And if they're topping out, 55 million shares, 10% short. Well, let me see the short float on SMCI. The short float as of April 15th on SMCI is 5.8%. Okay, so short's recovering. So it's not as aggressive as it was before, but still. Starbucks here down 10%. Yo, who goes to Starbucks every day? Put in the chat. Who actually like pulls up into a Starbucks and has their drink planned out and that you could say it with your eyes closed and like you actually get Starbucks? Because I go to Dunkin' every day. That's my cup of tea or cup of coffee, or cup of caramel latte. But who actually goes? Ryan goes 4 times a week. Steven goes every day. Chris says my wife. Mark's never been. You've never been to Starbucks, Mark? What? Valerio says never. Pink drink freaking rocks. I've never had the pink drink at all. Every other day, my daughter before school. I went to Starbucks when I was in college. There was a Starbucks nearby, the Rutgers Business School. So I would go to Starbucks then, but I don't go anymore. SMCI is now down 6%. Starbucks down 10%. Amazon still maintaining a pump. Amazon with that 2-pump strategy right now, but that's all we're getting. We need a little bit more than 2 pumps. So my girl tells me. Anyway, Amazon right here up 3%. Need a little bit more momentum here. They Instacart it at my office every day. Wow. That's interesting. Not bad. Bush Cream says, of course, your Indian ass goes to DD. I've got to support Indian businesses, dude. Got to support. One of my dreams is I want to make enough money from the market and open up a Dunkin' Donuts, dude. I really do. I want to open up a Dunkin' Donuts. Like it's going to cost about $1 million. So, maybe a decade from now, if I have $1 million liquid, I need to open up a Dunkin'. I feel like I have to do that before I die. It's like in my prophecy, my fucking destiny. Got to open up a Dunkin'. I've never purchased anything from Starbucks. Dude, it's so interesting. It's really, Starbucks is not having a good run. All right, so let's get some analysis on Starbucks. I think we have some coverage here. Here we go. Let's get some coverage on Starbucks.
Now is Kevin McCarthy, portfolio manager at Neuberger Berman. Kevin, it's great to have you on. You don't actually hold shares of Starbucks, but I am curious to get your thoughts on this, because on a day where we heard more commentary about cracks in the consumer, specifically the low-income consumer, with McDonald's this morning, with Coca-Cola this morning, just the latest to comment on that, the higher-end consumer has held in pretty well. And Starbucks historically has been more in the Chipotle camp than the McDonald's camp. So the fact that
hold on, how did she say that? How did she just say that? Hold on.
Chipotle camp then with McDonald's this morning, with Coca-Cola this morning, just the latest to comment on that, the higher end consumer has held in pretty well. And Starbucks historically has been more in the Chipotle camp than
Look, I love her. I love Morgan. I love her. But it's Chipotle. It's not Chipotle, whatever. It's Chipotle. It's everyone knows it's Chipotle. So interesting to see these people on live television say this shit wrong. Incredible, dude.
Then the McDonald's camp. So the fact that we saw same-store sales fall in North America, but also globally, including other key markets like China, what's the read-through?
I think, Morgan, thank you. The read-through is that we are seeing pressure across the complex geographically and by demographic income cohorts. I think McDonald's even recognized this morning or noted that they are seeing that a similar pressure across the board. The miss, though, however, for Starbucks is quite significant. I think at this point, a guidance reset is certainly in play. That we're looking for 15 to 20% growth. Coming into this print, I was thinking a 10%, lowered it to a 10% EPS would be sufficient. To be honest now, I don't even know if a plus mid-single digit, which would put the stock at, the EPS at around 370 for fiscal 24 is sufficient, because that in itself, would assume or underwrite expectations for double-digit EPS growth in the second half, and you need to have positive comps and positive margins. So, as it relates to the consumer, I think, one of the messages that we're hearing and the takeaway from the first quarter is that we all knew that pricing was going to be rolling off coming into the year, that it was going to be a challenge to get traffic, and that the kind of the digital pinpointing and trying to target consumers on this with their digital apps was a hope. And now I think we're seeing that hope is not coming through, and that more likely than not, we're going to see more aggressive value wars over the summer across the restaurant complex.
Yeah, we've already started to see it within the consumer staples space, the pushback from consumers on all of the price hikes and price increases. I mean, when we talk about a $6 or $7 fancy coffee, are we starting to see it here now as well?
For sure. I mean, they highlighted last quarter that one of their weaker periods or one of their weaker day parts was the afternoon, which is you're less frequent. It's more of a discretionary purchase. And so that is a challenge for them. But beyond that, I think the challenge, and I can kind of compare McDonald's and Starbucks because they both had a similar setup. They're both tracking from a traffic perspective below average, and they're below their long-term algo. But it's easier to diagnose McDonald's. McDonald's, they can put out national value, and you think that's going to be, price is going to cut it. For Starbucks, the challenges are you don't really know how to model, because you're not sure if is it a social issue? Is it a cannibalization issue? Is it a cold beverage mix, which they've now got a lot of, or is it competition?
Well, here's what I wonder about, Kevin. I'm looking at comparable transactions in North America and U.S. down 7%, but average ticket actually up 4%. So it makes me wonder, are they a victim of trade down, where maybe a certain segment of the population, maybe higher end, is still going to them and spending, but then a whole cohort has just kind of said, oh, well, I'm going to save on coffee and not do that and maybe make it at home?
That's absolutely could be the case. And I mean, we're seeing some consumer balking in the afternoon.
Based on that question, let me ask you guys in the chat. Do you guys go to get Starbucks for the actual drink? And I think it's a really interesting question. Or do you go for the therapeutic nature of going to get the drink? Like, I think they're one of the reasons people go to get coffee is because it's therapy to get in the car, go drive, go say hi to your local barista, get the coffee, come back. And like, people could make it themselves, but there's a feeling associated with going to get the drink. Does anyone have that feeling? Or is that just me? Or do you guys actually just go because you need some caffeine in the morning?
Day part, probably on what you're alluding to. But, if you look at some of the international regions, internationally, not only do they have, in the US, the price is positive and traffic is negative. But if you look at it internationally, they're both negative. So I think, for investors trying to pencil out how to model the second half of this year, you really don't have a lot of certainty that even if you do cut prices, which is obviously going to take a hit on the top line and on margins, that's going to drive traffic, and that's going to be, a source of upside for you in that case. And we haven't even gotten to China, which is another piece in of itself, which I think the underlying story there is just that, the possibility of that being an upside driver is probably pretty limited given what you've seen from a competitive dynamic there.
Looks that way. Starbucks down 10.5% so far in overtime. Kevin McCarthy, thank you.
Thank you.
Well, IPO.
Okay, so we're going to do SMCI, guys, in 5 minutes. and we'll listen to them for 30 minutes, and then we're going to go to Amazon at 5:30. So we got 30 minutes of SMCI. Where is SMCI right now? SMCI, wow, they're down 8%. They're down 8 freaking percent. This doesn't look good for tomorrow, because if Powell isn't excited tomorrow, I mean, like, these stocks seem like they're going to continue to get a little bit of pain. SMCI, let me pull up their thing. I've never heard their, I mean, I've heard their CEO talk once or twice, but I never really heard them on a call. So curious to see how they talk. Yeah, they're going to be live in 4 minutes, and then we'll hear from them and keep going. Where's Celsius? Is Celsius down because of Starbucks? Celsius 71. So Celsius was a stock that was 52, ballooned up to 100 after a good earnings, and now has come right back down. Maybe it's going to get a little bit of pain because the market feels that the consumer is slowing the spend. But the thing that I don't understand is that Domino's was up 5% yesterday. So people are dying, right? Or not dying. People, maybe they're dying from that. People are buying, right? And then so that's Domino's. And then CMG, Chipotle, is also up. People are buying from Chipotle. So it's not like consumers don't have the money to spend on a $7 coffee. It might be that Starbucks is tapping out potentially. That might be the case, right? Maybe that's, I don't know. Maybe, but that's what we're seeing right now for Starbucks. Really interesting that Starbucks is acting like this. AMD after hours down 5%. All right, AMD's down 5%. And then Amazon, again, just not being able to hold the pump. Really just not being able to hold the pump at all. Kelly says, I was literally going to get Domino's today. Now I'm scared I'm going to die. I'm having a lot of Freudian distractions tonight. I don't know what's going on. But Domino's, but we got to admit, Domino's sucks. Like, it's not good pizza. Like, we know Domino's sucks, dude. Domino's not good pizza. Also, I forgot, Starbucks is kind of dealing with some of the Israeli-Palestine issues, right? I think there's a lot of the Palestinian movement is telling people to not shop at McDonald's and at Starbucks. I don't know if that's the reason why their earnings are down. I mean, that's probably, there's definitely some sales they've lost from that, but I don't think that's a definitive reason why that's down. I don't think that could be the biggest reason. So yeah, that might be another thing that's contributing. I don't know if Amazon, I don't know if Jassy pumps during the call, but I do think like it's going to be a good call because the numbers are amazing. Again, just to review the numbers and then we'll get to SMCI. The numbers are spectacular for Amazon. I mean, some of the best numbers I think we've seen this earnings cycle so far. They beat Google and Microsoft on cloud. Net income is up 325%. Billion in revenue, 17% AWS growth. Barely up, but like this is one of those quarters you want, Amazon to have. Now, granted, they're reporting it a day before Powell, which sucks, but I think that's more the reason versus the earnings itself not being as good. Jack says, always for the experience of getting coffee. I like my caramel latte from Dunkin' every morning, but I do like the experience of going to drive and get it, to be honest. I actually enjoy that. Nvidia's down 1.3%. So I do think there is something there that consumers love the process of going to get what it's like a routine versus, being super scared versus like just loving the drink itself. Yeah, Nvidia's down 1.5%. So Nvidia's getting hit on SMCI. Let's look at all the semis. This is the list we have. Yeah. Oh, wow. Look at that. Everything's down. Intel is looking like it's going to go below 30. AMD is down 5%. Goodness gracious. AMD, $255 billion company. ARM is down 2%, below 100. Taiwan Semi, back to where it was before earnings, but that's down 1.34. Broadcom down 1%. ASML down about 0.3%. On Semiconductor, they had good earnings. They're down 1.11%. Lam Research down a little bit. And then SMCI down 8%. It looks like we know why they didn't give preliminary earnings now, even though the earnings weren't that crazy. It's what we expected, but still down. Bitcoin trying to get back to 60K. I wonder who's going to buy this dip. This one's also hurting so many stocks today. That one's giving us some pain. SMCI down 7%, Pinterest up 19, AMD down 5, Starbucks down 9.7, and Amazon up 2.5. All right, let's get to the call. For SMCI, 30 minutes, and then we're going to Amazon at 5:30. All right, so just so everyone knows, if you want the full SMCI call, have another call loaded up because at 5:30 we're leaving for Amazon. They should be starting relatively soon. I'd buy Intel at 25. Yeah, I mean, Intel at 25 would be exciting. I'm just a little afraid they might be a little bit of a value trap right now. All right, here we go.
Thank you for standing by. My name is Joel, and I will be your conference operator today. At this time, I would like to welcome everyone to the Super Microcomputer Fiscal Q3 2024 results on April 30th, 2024. With us today, Charles Liang, Founder, President, and Chief Executive Officer, David Wiegand, CFO, and Michael Stager, Vice President of Corporate Development. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to queue for a question during today's call, you can do so by dialing *1. Thank you.
Good afternoon, and thank you for attending Supermicro's call to discuss financial results for the third quarter, which ended March 31st, 2024. With me today are Charles Liang, Founder, Chairman, and Chief Executive Officer, and David Wiegand, Chief Financial Officer. By now, you should have received a copy of the news release from the company that was distributed at the close of regular trading and is available on the company's website. As a reminder, during today's call, the company will refer to a presentation that is available to participants in the Investor Relations section of the company's website under the Events and Presentations tab. We have published management's scripted commentary on our website. Please note that some of the information you'll hear during our discussion today will consist of forward-looking statements, including without limitation, those regarding revenue, gross margin, operating expenses, and other income and expenses, taxes, capital allocation, and future business outlook, including guidance for the fourth quarter of fiscal year 2024 and the full fiscal year 2024. There are a number of risk factors that can cause Supermicro's future results to differ materially from our expectations. You can learn more about these risks in the press release we issued earlier this afternoon, our most recent 10-K filing for fiscal 23, and our other SEC filings. All these documents are available on the Investor Relations page of Supermicro's website. We assume no obligation to update any forward-looking statements. Most of today's presentation will refer to non-GAAP financial results and business outlook. For an explanation of our non-GAAP financial measures, please refer to the accompanying presentation or to our press release published earlier today. In addition, a reconciliation of GAAP to non-GAAP results is contained in today's press release and in the supplemental information attached to today's presentation. At the end of today's prepared remarks, we will have a Q&A session for sell-side analysts to ask questions. I'll now turn the call over to Charles.
Thank you, Michael, and good afternoon, everyone. We achieved another record-breaking quarter with a revenue of $3.85 billion, a 200% increase from the same time last year, and the non-GAAP earnings per share of $6.65, up more than 308% year-on-year. Supermicro is at the forefront of the current AI revolution. These strong results reflect the continued demand for our rack-scale, plug-and-play total AI solutions. We continue to face some supply chain challenge due to a new product that require new key components, especially liquid cooling, DLC-related components, and believe this situation will gradually improve in the coming quarters. To sustain this rapid growth, we are making significant investment in production, operation, management software, cloud features, and customer service to further increase our customer base and bring more value to them. To support this scale up, we raised an additional $3.28 billion through a convertible note and secondary equity offering in the quarter. We'd like to support strong short and long-term growth with minimal equity dilution. Overall, I remain optimistic that AI growth will continue for many quarters, if not many years to come. We have long recognized that AI is accelerating the need for liquid cooling, and we have invested heavily into high-quality, optimized direct liquid cooling DLC solutions for high-end CSP and NCPs. With GPU reaching 700 watts and soon more than 1,000 watts, efficiently managing the heat from this AI system has become critical for many customers, especially at the new data centers. I am pleased to announce that our new DLC, liquid cooling, building block, and rack scale total solution technology are finally fully ready for high volume production. With our DLC liquid cooling technology, customers can reduce their expense on cooling expense, saving data center space, and allocate a greater portion of their finite power resource to computing instead of cooling, which align with our green computing DNA well. Now, let's go over some key financial highlights. Supermicro is pleased to be included in the prestigious S&P 500 index last quarter. Fiscal Q3 net revenue total $3.85 billion, up 200% year-on-year, within our aggressive original guidance of March quarter. If not limited by some key component shortage, we could have delivered more. Fiscal Q3 non-GAAP earnings of $6.65 per share were well above $1.63 last year, which was about 308% year-on-year growth. Our increasing economic of scale contributed to better net profit. Our year-over-year operating margin and net income both continue to improve, and we continue to expect a further benefit as we bring our Malaysia facility online later in this calendar year. This fast-growing quarter.
Guys, AMD is live. I'm switching to them. AMD is live. I'm switching to them. Okay.
And FP8. Our partners are seeing very strong performance in their AI workloads. As we jointly optimize for their models, MI300X GPUs are delivering leadership inferencing performance and substantial TCO advantages compared to H100. For instance, several of our partners are seeing significant increases in tokens per second when running their flagship LLMs on MI300X compared to H100. We're also continuing to enable the broad ecosystem required to power the next generation of AI systems, including as a founding member of the Ultra Ethernet Consortium, working to optimize the widely adopted Ethernet protocol to run AI workloads at data center scale. MI300 demand continues to strengthen, and based on our expanding customer engagements, we now expect data center GPU revenue to exceed $4 billion in 2024, up from the $3.5 billion we guided in January. Longer term, we are increasingly working closer with our cloud and enterprise customers as we expand and accelerate our AI hardware and software roadmaps and grow our data center GPU footprint. Turning to our client segment, revenue was $1.4 billion, an increase of 85% year-over-year, driven by strong demand for our latest generation Ryzen mobile and desktop processors with OEMs and in the channel. Client segment revenue declined 6% sequentially. We saw strong demand for our latest generation Ryzen processors in the first quarter. Ryzen desktop CPU sales grew by a strong double-digit percentage year-over-year, and Ryzen mobile CPU sales nearly doubled year-over-year, as new Ryzen 8040 notebook designs from Acer, ASUS, HP, Lenovo, and others ramped. We expanded our portfolio of leadership enterprise PC offerings with the launch of our Ryzen Pro 8000 processors earlier this month. Ryzen Pro 8040 mobile CPUs deliver industry-leading performance and battery life for commercial notebooks. And our Ryzen Pro 8000 series desktop CPUs are the first processor to offer dedicated on-chip AI accelerators in commercial desktop PCs. We see clear opportunities to gain additional commercial PC share based on the performance and efficiency advantages of our Ryzen Pro portfolio and an expanded set of AMD-powered commercial PCs from our OEM partners. Looking forward, we believe the market is on track to return to annual growth in 2024, driven by the start of an enterprise refresh cycle and AI PC adoption. We see AI as the biggest inflection point in PCs since the internet, with the ability to deliver unprecedented productivity and usability gains. We're working very closely with Microsoft and a broad ecosystem of partners to enable the next generation of AI experiences powered by Ryzen processors, with more than 150 ISVs on track to be developing for AMD AI PCs by the end of the year. We will also take the next major step in our AI PC roadmap later this year with the launch of our next generation Ryzen mobile processors, codenamed Strix. Customer interest in Strix is very high based on the significant performance and energy efficiency uplifts we are delivering. Design win momentum for premium notebooks is outpacing prior generations as Strix enables next generation AI experiences in laptops that are thinner, lighter, and faster than ever before. We're excited about the growth opportunities for the PC market, and based on the strength of our Ryzen CPU portfolio, we expect to grow revenue share this year. Now turning to our gaming segment, revenue declined 48% year over year and 33% sequentially to $922 million. First quarter semi-custom SoC sales declined in line with our projections as we are now in the fifth year of the console cycle. In gaming graphics, revenue declined year over year and sequentially. We expanded our Radeon 7000 series family with the global launch of our Radeon RX 7900 GRE and also introduced our driver-based AMD Fluid Motion Frames technology that can provide large performance increases in thousands of games. Turning to our embedded segment, revenue decreased 46% year over year and 20% sequentially to $846 million, as customers remain focused on normalizing their inventory levels. We launched our Spartan UltraScale Plus FPGA family with high I/O counts, power efficiency, and state-of-the-art security features, and we're seeing a strong pipeline of growth for our cost-optimized embedded portfolio across multiple markets. Given the current embedded market conditions, we're now expecting second quarter embedded segment revenue to be flat sequentially, with a gradual recovery in the second half of the year. Longer term, we see AI at the edge as a large growth opportunity that will drive increased demand for compute across a wide range of devices. To address this demand, we announced our second generation of Versal adaptive SoCs that deliver a 3x increase in AI TOPS per watt and a 10x greater scalar compute performance compared to our prior generation of industry-leading adaptive SoCs. Versal Gen 2 adaptive SoCs are the only solution that combine multiple compute engines to handle AI preprocessing, inferencing, and post-processing on a single chip, enabling customers to rapidly add highly performant and efficient AI capabilities to a broad range of products. We were pleased to be joined at our launch by Subaru, who announced they adopted Versal AI Edge Series Gen 2 devices to power the next generation of their EyeSight ADAS system. Embedded design win momentum remains very strong as customers adopt our full portfolio of FPGAs, CPUs, GPUs, and adaptive SoCs to address a larger portion of their compute needs. In summary, we executed well in the first quarter, setting us up to deliver strong annual revenue growth and expanded gross margin driven by growing adoption of our Instinct, EPYC, and Ryzen product portfolios. Our priorities for 2024 are very clear. Accelerate our data center growth by ramping Instinct GPU production and gaining share with our EPYC processors. Launch our next generation Zen 5 PC and server processors that extend our leadership performance, and expand our adaptive computing portfolio with differentiated solutions. Looking further ahead, AI represents an unprecedented opportunity for AMD. While there has been significant growth in AI infrastructure buildouts, we are still in the very early stages of what we believe is going to be a period of sustained growth driven by an insatiable demand for both high-performance AI and general-purpose compute. We have expanded our investments across the company to capture this large growth opportunity, from rapidly expanding our AI software stack to accelerating our AI hardware roadmaps, increasing our go-to-market activities, and partnering closely with the largest AI companies to co-optimize solutions for their most important workloads. We are very excited about the trajectory of the business and the significant growth opportunities ahead. Now I'd like to turn the call over to Jean to provide some additional color on our first quarter results. Jean?
Thank you, Lisa, and good afternoon, everyone. I'll start with a review of our financial results and then provide our current outlook for the second quarter of fiscal 2024. We delivered a strong year-over-year revenue growth in our data center and client segments in the first quarter and drew 230 basis points of gross margin expansion. For the first quarter of 2024, revenue was $5.5 billion, up 2% year-over-year, as revenue growth in the data center and the client segment was partially offset by lower revenue in our gaming and embedded segment. Revenue declined 11% sequentially as higher data center revenue resulting from the ramp of our AMD Instinct GPUs was offset by lower gaming and embedded segment revenues. Gross margin was 52%, up 230 basis points year-over-year, driven by higher revenue contribution from the data center and the client segment, partially offset by lower embedded and the gaming segment revenue contribution. Operating expenses were $1.7 billion, an increase of 10% year-over-year, as we continued investing aggressively in R&D and marketing activities to address the significant AI growth opportunities ahead of us. Operating income was $1.1 billion, representing a 21% operating margin. Taxes, interest expense, and other was $120 million. For the fourth quarter of 2024, diluted earnings per share was 62 cents, an increase of 3% year-over-year. Now turning to our reportable segments, starting with the data center. Data center delivered record quarterly segment revenue of $2.3 billion, up 80%, a $1 billion increase year-over-year. Data center accounted for more than 40% of total revenue, primarily led by the ramp of AMD Instinct GPUs from both cloud and enterprise customers, and a strong double-digit percentage growth in our server processor revenue as a result of growth across our Zen 4 product. On a sequential basis, revenue increased 2%, driven by the ramp of our AMD Instinct GPUs, partially offset by seasonal decline in server CPU sales. Data center segment operating income was $541 million, or 23% of revenue, compared to $148 million, or 11% a year ago. Operating income was up 266% year-over-year due to operating leverage, even as we significantly increased our investment in R&D. Client segment revenue was $1.4 billion, up 85% year-over-year, driven primarily by Ryzen 8000 series processors. On a sequential basis, client revenue declined 6%. Client segment operating income was $86 million, or 6% of revenue, compared to an operating loss of $172 million a year ago, driven by higher revenue. Gaming segment revenue was $922 million, down 48% year-over-year and down 33% sequentially due to a decrease in semi-custom and Radeon GPU sales. Gaming segment operating income was $151 million, or 16% of revenue, compared to $314 million, or 18% a year ago. Embedded segment revenue was $846 million, down 46% year-over-year, 20% sequentially, as customers continue to manage their inventory levels. Embedded segment operating income was $342 million, or 41% of revenue, compared to $798 million, or 51% a year ago. Turning to the balance sheet and the cash flow. During the quarter, we generated $521 million in cash from operations, and the free cash flow was $379 million. Inventory increased sequentially by $301 million to $4.7 billion, primarily to support the continued ramp of data center and client products in advanced process nodes. At the end of the quarter, cash equivalents, and short-term investment was $6 billion. As a reminder, we have $750 million of debt maturing this June. Given our ample liquidity, we plan to retire the debt utilizing existing cash. Now turning to our second quarter 2024 outlook. We expect revenue to be approximately $5.7 billion ± $300 million. Sequentially, we expect data center segment revenue to increase by double-digit percentage, primarily driven by the data center GPU ramp. Client segment revenue to increase, embedded segment revenue to be flat. And in the gaming segment, based on current demand signals, revenue to decline by significant double-digit percentage. Year-over-year, we expect our data center and client segment revenue to be up significantly, driven by the strength of our product portfolio. The embedded and the gaming segment revenue to decline by a significant double-digit percentage. In addition, we expect second quarter non-GAAP gross margin to be approximately 53%. Non-GAAP operating expenses to be approximately $1.8 billion. Non-GAAP effective tax rate to be 13%, and the diluted share count is expected to be approximately 1.64 billion shares. In closing, we started the year strong. We made significant progress on our strategic priorities, delivered year-over-year revenue growth in our data center and the client segment, and expanded the growth.
All right, we're done with that. These earnings calls, dude, we're going to have Amazon in 9 minutes. These earnings calls, I think they need to be updated in terms of their structure. I don't understand why they're reading all those results. The analysts have the decks. Everyone sees those decks. Like even PayPal today, for 20 minutes, they're saying transaction volumes were blah, blah, blah. We don't need to hear them say that, right? Like it just does not make sense to me. Why are they repeating what we're reading? The Q&A is the only part that matters. Like opening statements from the CEO, maybe another C-suite like the CFO, and then Q&A. Why do you need to literally read a PowerPoint? It just makes absolutely no sense. They should make it a theatrical event. Yeah, I agree. And there should be video too. I mean, like, but even if we don't have video, we should at least not be reading from a PowerPoint. It just makes no sense to me. So we got Amazon soon. Let's see what happens. Overall, S&P right now is at 501. Looks like we're going to go below 500 again. NVIDIA is down 1.28%. AMD is getting destroyed, 7%. That call obviously not helping. They're at 147 right now. This was a company that was 225 4 weeks ago. Roundabout. Well, let's check the chart. They were 225, 227 March 8th. Yeah, so about 4 weeks ago. Or almost, no, 6 weeks ago at this point. So it was a while ago. Now they're down at that 144 range. When it got to 227, even I was just like, okay, this is getting stupid right now. There is no reason why it's pumping. But that one did pump. NVIDIA, you could justify the pump. AMD, you couldn't. So AMD deserves to be here. I think it gets more exciting around 125. We'll see if it gets there. I don't know if it gets that bad. But AMD right here, 147. Chipotle is down about 2% after hours. Domino's is flat after hours. SPY 501. Celsius down 2%, kind of probably from the Starbucks debacle. And then Starbucks. So here's my question for everyone on Starbucks, down 9%. And oh, where's Amazon? Is Amazon green? Amazon is still green, up 3%, which is nice because everything else is red. Do we think Starbucks going down is a function of Starbucks, or it's a function of the consumer? What do you think? Do you think it's Starbucks or the consumer? I kind of think it's Starbucks. I don't think it's the consumer. I think the consumer is healthy. We have jobs. We're spending. We're, people are still buying pizza and stuff. Like, I don't know why. I think it's more a Starbucks thing. Like maybe now, granted, if my logic is maybe the coffee's getting too expensive, that is kind of a consumer problem, right? Because why is the coffee getting expensive all of a sudden, right? Maybe inflation's ticking up. Maybe people aren't willing to pay that much anymore. So there has to be something. Obviously, China was bad, but in the United States, North American sales are down 6% year over year as well, which is very concerning. I mean, Starbucks has a phenomenal brand. They should not be losing market share like that. Tesla down 1% after hours. SoFi down another 1% after hours as well. PayPal now red after hours, but still up for the day. PayPal should be at $73. But today was just a rough day, so that's why PayPal's down. I think if Powell's okay tomorrow, PayPal will be all right. I think the market's scared about Powell. I really think they are, and that's why we're seeing some of this downside momentum. QQQ down 2% of the day, down another 0.3% after hours. I think the market is really scared that Powell's going to say something that indicates a hike is coming, that the bears were correct about this massive credit event. And then if that's the case, forget whatever stock you own. We're all going down the drain. Like there's no saving at that point. We're done, right? Unless you're short, unless you have SQQQ, it's going to be a tough day. That one's up 6% right now. So I think it's the Powell. I think it's Powell's potential of tanking the market, which has the market very scared. And if he doesn't, maybe we see a nice little rally. One thing, we heard Tom Lee talk about this, is that like in a bull market, it's not that easy for dips to continue dipping, right? Things get bought up relatively quickly because people want to get into the markets. There's $6 trillion on the sidelines. If inflation data is lagging, then eventually will come down, and that will impact a lot of different, not only consumer segmentations, but supply chains. We saw Costco say that they're seeing disinflation in their supply chains, and Costco, a massive company, even though they missed on their revenues, still Costco was able to show that. I mean, Costco's giving a dividend. They're increasing their dividend by 14 cents because they literally have so much money they don't know what to do, right? If there was so much rapid inflation, I don't think they would be trying to give them money back. They would be concerned a little bit and trying to watch their costs. So I don't know. I don't know. I think the consumer is still in a healthy spot. A lot of you guys here are saying that it might be the consumer in the chat. June says people are cutting sugar. That might be an argument. Maybe for why people are not engaging with Starbucks as much anymore. Starbucks needs more innovation, low key. Like if they produce low cal, relatively high caffeine drinks, they can kill the rest of the energy drink market. Yeah, I mean, people picking up a Celsius might not be picking up a caramel latte, right? That could also be an argument. And that could be one of the reasons why Starbucks is not the best. Thomas says expensive coffee is an easy thing to cut on. Just make cheaper coffee at home and you don't lose anything but the experience. Yeah, that's true. And again, maybe if we'll see Celsius earnings, because if Celsius takes a dip, then there's a problem with the consumer. If people can't buy a $2 energy drink or a $5 latte, there's an issue. But I don't expect that to be the case. I really do think this is more Starbucks related versus consumer related. Speaking of Ozempic, as Lewis says in the chat, Eli Lilly, phenomenal earnings today. I mean, they absolutely crushed. Up 6% on the day, 781. Great earnings. They did what they had to do. $742 billion market cap. They're up 33% year to date. One of the few companies outside of the sort of big tech, or outside of the NASDAQ, that has been able to pump really well. I mean, them and Chipotle are up 30% year to date, and they're not big tech. So not bad for Eli Lilly, but AMD and Nvidia just not getting the time of day. AMD now down 6.7%. Who bought calls for any of these companies? Who bought calls? Who did an earnings play for AMD, Pinterest, Starbucks? We'll have the call in about 2 minutes for Amazon. Or Amazon. Did anyone actually do any options plays on these guys? Because if you did it on Pinterest, you're good. If you did it on everything else, you're kind of tough. Maybe Amazon's okay. Lemonade, we didn't go through their results, but they're up 8%. So Lemonade had a good one. Amazon right now up 2.6%. Shashank had Amazon calls. Tony at Amazon calls. Kenneth YOLO'd on AMD. Han Solo, I sold stupid Starbucks puts. You can roll them. Han. As long as I mean, you might not get the best premium, but you can still roll them. So you're not gonna have to be assigned the shares, I imagine, based on the expiration, hopefully. But yeah, you should be able to roll them. I mean, unless it goes down 20%, then the premiums are gonna be bad. But you should be okay. Calls on AMC, okay. That's fine. Texas Roadhouse. Yeah, Texas Roadhouse did great as well. So again, the food companies are not doing that bad. Restaurants are not doing that horrible. Amazon calls at 190. Okay. So most people were bullish on Amazon. We had that poll. 70% of people said, let me close that poll now. 70% of people said Amazon would go up, which they're right. Just not as much as we wanted it to go up. Amazon August calls 200 strike. See, August, to say Amazon will be August by 200 is not crazy. The question is, will Jerome Powell allow the economy to get to that point? It's really contingent upon him, I think, at this point. And we're going to have to see. We got some slides here on Amazon as well. We went through the numbers, but AWS was the big thing. Look at Q1 to Q1 over the year. It's up 229% year over year. 3.1 billion to 10.4 billion. I mean, pretty incredible stuff. Now the call just has to go well, and I think Jassy is gonna do all right and lay out his vision here. All right, here we go.
Thank you for standing by. Good day, everyone, and welcome to the Amazon.com First Quarter 2024 Financial Results Teleconference. At this time, all participants are in a listen-only mode. After the presentation, we will conduct a question-and-answer session. Today's call is being recorded, and for opening remarks, I will be turning the call over to the Vice President of Investor Relations, Mr. Dave Fildes. Please go ahead.
Hello, and welcome to our Q1 2024 Financial Results Conference Call. Joining us today to answer your questions is Andy Jassy, our CEO, and Brian Olsavsky, our CFO. As you listen to today's conference call, we encourage you to have our press release in front of you, which includes our financial results as well as metrics and commentary on the quarter. Please note, unless otherwise stated, all comparisons in this call will be against our results for the comparable period of 2023. Our comments and responses to your questions reflect management's views as of today, April 30th, 2024 only, and will include forward-looking statements. Actual results may differ materially. Additional information about factors that could potentially impact our financial results is included in today's press release and our filings with the SEC, including our most recent annual report on Form 10-K and subsequent filings. During this call, we may discuss certain non-GAAP financial measures. In our press release, slides accompanying this webcast, and our filings with the SEC, each of which is posted on our IR website, you will find additional disclosures regarding these non-GAAP measures, including reconciliations of these measures with comparable GAAP measures. Our guidance incorporates the order trends that we've seen to date and what we believe today to be appropriate assumptions. Our results are inherently unpredictable and may be materially affected by many factors, including fluctuations in foreign exchange rates, changes in global economic and geopolitical conditions and customer demand and spending, including the impact of recessionary fears, inflation, interest rates, regional labor market constraints, world events, the rate of growth of the internet, online commerce, cloud services, and new and emerging technologies, and the various factors detailed in our filings with the SEC. Our guidance assumes, among other things, that we don't conclude any additional business acquisitions, restructurings, or legal settlements. It's not possible to accurately predict demand for our goods and services, and therefore our actual results could differ materially from our guidance. And now, I'll turn the call over to Andy.
Thanks, Dave. Today we're reporting $143.3 billion in revenue, up 13% year over year, excluding the impact from foreign exchange rates, $15.3 billion in operating income, up 221% year over year, or $10.5 billion, and $48.8 billion in trailing 12-month free cash flow adjusted for equipment finance leases, up $53.2 billion year over year. We remain focused on driving better experiences for our customers while also delivering efficiency improvements. Our financial results are an encouraging reminder of the progress we're making. Starting with our stores business, despite having hundreds of millions of items and the broadest selection available, we remain intensely focused on adding even more selection. One way is to continue adding brands we know our customers want. For instance, in the US, we recently welcomed Clinique and two Gen Z fashion favorites, Parade and Cider, and announced a collaboration with Hardly Ever Worn It in Europe to offer customers pre-owned items from luxury brands. Another way to drive selection is to make it easier for our third-party sellers to add their products to our store. We've recently launched a new generative AI tool that enables sellers to simply provide a URL to their own website, and we automatically create high-quality product detail pages on Amazon. Already, over 100,000 of our selling partners have used one or more of our Gen AI tools. We remain focused on making sure we're offering everyday low prices, which we know is even more important to our customers in this uncertain economic environment. As our results show, customers are shopping but remain cautious, trading down on price when they can, and seeking out deals. In Q1, we helped customers save with shopping events worldwide, including our first big spring sale in Canada and the US. We also held Spring Deal Days in Europe and a Ramadan event in Egypt, Saudi Arabia, and the UAE. Delivery speed really matters to customers, and we've continued to get faster while improving our safety performance. In this past Q1, we delivered to Prime members at our fastest speeds ever. In March, across our top 60 largest U.S. metro areas, nearly 60% of Prime members' orders arrived the same or next day. And globally, in cities like Toronto, London, and Tokyo, about 3 out of 4 items were delivered the same or next day. Faster delivery times have another important effect. As we get items to customers this fast, Customers choose Amazon to fulfill their shopping needs more frequently, and we can see the results in various areas, including how fast our everyday essentials business is growing and the continued increase in Prime member purchase frequency and total spend with us. Over the past year, we've talked about how our regionalization efforts have helped lower our cost to serve. We've continued to inspect our fulfillment network for additional opportunities and are working on several areas where we believe we can lower costs even further while also improving customer experience. One example of this is our work to increase the consolidation of units into fewer boxes. As we further optimize our network, we've seen an increase in the number of units delivered per box, an important driver for reducing our costs. When we're able to consolidate more units into a box, it results in fewer boxes and deliveries, a better customer experience, reduces our cost to serve, and lowers our carbon impact. Another prominent example is our efforts to revamp our U.S. inbound fulfillment architecture to allow for better inventory placement closer to our customers. This will be an iterative process throughout the year as we work with sellers and retail partners, and teams are making good progress on their plans. Advertising performance remains strong, with ad sales up 24% year over year, excluding the impact of foreign exchange. The strength in advertising was primarily driven by sponsored products, supported by continued improvements in relevancy and measurement capabilities for advertisers. We still see significant opportunity ahead in our sponsored products, as well as areas where we're just getting started, like Prime Video ads. Prime Video ads offers brands values we can better link the impact of streaming TV advertising to business outcomes, like product sales or subscription signups, whether the brands sell on Amazon or not. It's very early for streaming TV ads, but we're encouraged by the early response. Moving to AWS, year-over-year revenue growth accelerated to 17.2% in Q1, up from 13.2% in Q4. It's useful to remember that year-over-year percentages are only relevant relative to the total base from which you start. And given our much larger infrastructure cloud computing base, at this growth rate, we see more absolute dollar growth again quarter over quarter in AWS than we can see elsewhere. We're seeing a few trends right now. First, companies have largely completed the lion's share of their cost optimization and turned their attention to newer initiatives. Before the pandemic, companies were marching to modernize their infrastructure, moving from on-premises infrastructure to the cloud to save money, innovate at a more rapid rate, and to drive more developer productivity. The pandemic and uncertain economy that followed distracted from that momentum, but it's picking up again. Companies are pursuing this relatively low-hanging fruit of modernizing their infrastructure, and with the broadest functionality by a fair bit, deepest partner ecosystem, and strongest security and operational performance, AWS continues to be their strong partner of choice. Our AWS customers are also quite excited about leveraging Gen AI to change their customer experiences and businesses. We see considerable momentum on the AI front, where we've accumulated a multi-billion-dollar revenue run rate already. You've heard me talk about our approach before, and we continue to add capabilities at all three layers of the Gen AI stack. At the bottom layer, which is for developers and companies building models themselves, we see excitement about our offerings. We have the broadest selection of NVIDIA compute instances around, but demand for our custom silicon, Trainium and Inferentia, is quite high given its favorable price-performance benefits relative to available alternatives. Larger quantities of our latest generation Trainium 2 is coming in the second half of 2024 and early 2025. Companies are also starting to talk about the eye-opening results they're getting using SageMaker. Our managed end-to-end service has been a game changer for developers in preparing their data for AI, managing experiments, training models faster, lowering inference latency, and improving developer productivity. Perplexity AI trains models 40% faster in SageMaker. Workday reduces inference latency by 80% with SageMaker, and NatWest reduces its time to value for AI from 12 to 18 months to under 7 months using SageMaker. This changes how challenging it is to build your own models, and we see an increasing number of model builders standardizing on SageMaker. The middle layer of this stack is for developers and companies who prefer not to build models from scratch, but rather seek to leverage an existing large language model, or LLM, customize it with their own data, and have the easiest and best features available to deploy secure, high-quality, low-latency, cost-effective production Gen AI apps. This is why we built Amazon Bedrock, which not only has the broadest selection of LLMs available to customers, but also unusually compelling model evaluation, retrieval augmented generation, or RAG, to expand models' knowledge base, guardrails to safeguard what questions applications will answer, agents to complete multi-step tasks, and fine-tuning to keep teaching and refining models. Bedrock already has tens of thousands of customers, including Adidas, New York Stock Exchange, Pfizer, Ryanair, and Toyota. In the last few months, Bedrock's added Anthropic's Claude 3 models, the best performing models on the planet right now, Meta's Llama 3 models, Mistral's various models, Cohere's newest models, and new first-party Amazon Titan models. A week ago, Bedrock launched a series of other features, but perhaps most importantly, custom model import. Custom model import is a sneaky big launch as it satisfies a customer request we've heard frequently and that nobody has yet met. As increasingly more customers are using SageMaker to build their models, they're wanting to take advantage of all the Bedrock features I mentioned earlier that make it so much easier to build high-quality production-grade Gen AI apps. Bedrock Custom Model Import makes it simple to import models from SageMaker or elsewhere into Bedrock before deploying their application. Customers are excited about this, and as more companies find they're employing a mix of custom-built models along with leveraging existing LLMs, the prospect of these two linchpin services in SageMaker and Bedrock working well together is quite appealing. The top of the stack are the Gen AI applications being built, and today we announced the general availability of Amazon Q, the most capable generative AI-powered assistant for software development and leveraging companies' internal data. On the software development side, Q doesn't just generate code, it also tests code, debugs coding conflicts, and transforms code from one form to another. Today, developers can save months using Q to move from older versions of Java to newer, more secure and capable ones. In the near future, Q will help developers transform their .NET code as well, helping them move from Windows to Linux. Q also has a unique capability called agents, which can autonomously perform a range of tasks, everything from implementing features, documenting, and refactoring code to performing software upgrades. Developers can simply ask Amazon Q to implement an application feature, such as asking it to create an Add to Favorites feature in a social sharing app, and the agent will analyze their existing application code and generate a step-by-step implementation plan, including code changes across multiple files and suggested new functions. Developers can collaborate with the agent to review and iterate on the plan, and then the agent implements it, connecting multiple steps together and applying updates across multiple files, code blocks, and test suites. It's quite handy. On the internal data side, most companies have large troves of internally relevant data that resides in wikis, internet pages, Salesforce, storage repositories like Amazon S3, and a bevy of other data stores and SaaS apps that are hard to access. It makes answering straightforward questions about company policies, products, business results, code, people, and many other topics hard and frustrating. Q makes this much simpler. You can point Q at all of your enterprise data repositories, and it'll search all this data, summarize logically, analyze trends, and engage in dialogue with customers about this data. We also introduced today a powerful new capability called Q Apps, which lets employees describe in natural language what apps they want to build on top of this internal data, and Q Apps will quickly generate that app. This is going to make it so much easier for internal teams to build useful apps from their own data. Q is not only the most functionally capable AI-powered assistant for software development and data, but also setting the standard for performance. Q is the highest known score and acceptance rate for code suggestions, outperforms all other publicly benchmarkable competitors on catching security vulnerabilities, and leads all software development assistants on connecting multiple steps together and applying automatic actions. Customers are gravitating to Q, and we already see companies like Brightcove, British Telecom, Datadog, GitLab, GoDaddy, National Australia Bank, NCS, NetSmart, Slalom, Smartsheet, Sun Life, Tata Consultancy Services, Toyota, and Wiz using Q. And we've only been in beta till today. I'd also caution folks not to overlook the security and operational performance elements of these Gen AI services. It's less sexy, but critically important. Most companies care deeply about the privacy of the data in their AI applications and the reliability of their training and production apps. If you've been paying attention to what's been happening the last year or so, you can see there are big differences between providers on these dimensions. AWS has a meaningful edge, which is adding to the number of companies moving their AI focus to AWS. We expect the combination of AWS's re-accelerating growth and high demand for Gen AI to meaningfully increase year-over-year capital expenditures in 2024, which, given the way the AWS business model works, is a positive sign of the future growth. The more demand AWS has, the more we have to procure new data centers, power, and hardware. And as a reminder, we spend most of the capital up front, but as you've seen over the last several years, we make that up in operating margin and free cash flow down the road as demand steadies out. And we don't spend the capital without very clear signals that we can monetize it this way. We remain very bullish in AWS. We're at a $100 billion plus annualized revenue run rate, yet 85% or more of the global IT spend remains on premises. And this is before you even calculate Gen AI, most of which will be created over the next 10 to 20 years from scratch and on the cloud. There's a very large opportunity in front of us. We also continue to make strong progress on our newer investments. Our emerging international stores are growing and moving towards profitability. Our third-party logistics business, offering services like Buy with Prime, Amazon Shipping, and multi-channel fulfillment, continues to grow well. We just launched a Prime delivery grocery benefit that lets customers receive free unlimited grocery delivery for just $9.99 a month, which is great value, and customers are responding accordingly. Later this year in Manhattan, we're launching a new, smaller Whole Foods Market concept called Whole Foods Market Daily Shop. Prime Video continues to produce compelling content, with Fallout being our latest big hit on the heels of the very successful Roadhouse movie, with strong customer engagement in our original and partner content. Our health services business is growing robustly as customers are loving our pharmacy customer experience, and we've launched same-day delivery of prescription medications to customers in 8 cities, including Los Angeles and New York City, with plans to expand to more than a dozen cities by the end of the year, with customers now getting first fill medications 75% faster year over year nationwide. And Kuiper is getting closer to having its production satellites in space and entering our commercial beta. There's a lot of invention happening across our business, and I'm super grateful to all our employees for their hard work and ingenuity. I'll close by sharing that I'm enthusiastic about how we started this year. We have a lot of opportunity in front of us in every one of our businesses to make our customers' lives better and easier. With that, I'll turn it over to Brian for a financial update.
Thanks, Andy. Starting with our top-line financial results. Worldwide revenue was $143.3 billion, representing a 13% increase year over year, excluding the impact of foreign exchange, and near the top end of our guidance range. I'd like to highlight a couple points to help you interpret our growth rates. First, we saw an impact from leap year in Q1, which added approximately 120 basis points to the year-over-year quarterly revenue growth rate. Second, while I typically talk about growth rates excluding the impact of year-over-year changes in foreign exchange, we did see an unfavorable impact from global currencies weakening against the US dollar more than we had planned in Q1. This led to a $700 million or 50 basis point headwind to revenue relative to what we guided. Excluding this FX headwind, we would have exceeded the top end of our guidance range. Worldwide operating income was $15.3 billion, which was our highest quarterly income ever. And it was $3.3 billion above the high end of our guidance range. This was driven by strong operational performance across all 3 reportable segments and better than expected operating leverage, including lower cost to serve. The impact on operating income from our Q1 FX rate headwind was negligible. I'll speak more to our profitability trends in a moment. In the North America segment, first quarter revenue was $86.3 billion, an increase of 12% year over year. In the international segment, revenue was $31.9 billion, an increase of 11% year over year, excluding the impact of foreign exchange. We remain focused on the inputs that matter most to our customers: selection, price, and convenience. During the quarter, around the world, we helped customers save with our shopping events. We added selection, including premium and luxury brands, and we delivered at our fastest speeds ever for Prime members. Third-party sellers continue to be an important part of our offering. Third-party seller services revenue increased 16% year over year, excluding the impact of foreign exchange. We saw strong 3P unit growth, coupled with increased adoption of our optional services such as fulfillment and global logistics. For the quarter, third-party seller unit mix was 61%, up 200 basis points year over year. Shifting to profitability, North America segment operating income was $5 billion, an increase of $4.1 billion year over year. Operating margin was 5.8%, up 460 basis points year over year. We saw improvements in our cost to serve, including continued benefit from our work to regionalize our operations, savings from more consolidated customer shipments, and improved leverage driven by strong unit growth and lower transportation rates. In our international segment, operating income was $903 million, an improvement of $2.2 billion year over year. Operating margin was 2.8%, up 710 basis points year over year. This is primarily driven by our established countries as we improve cost efficiencies through network design enhancements and improved volume leverage. Additionally, we saw good progress in our emerging countries as they expand their customer offerings and make strides on their respective journeys to profitability. Looking ahead, we see several opportunities to further lower cost to serve and improve profitability in our worldwide stores business while still investing to improve the customer experience. Within our fulfillment network, we are focused on investing in our inbound network, streamlining and standardizing process paths, and adding robotics and automation. These improvement opportunities will take time. However, we have a solid plan in place and we like the path we are on. Advertising remains an important contributor to profitability in North America and international segments. We see many opportunities to grow our offerings, both in the areas that are driving growth today, like sponsored products, and in areas that are newer, like streaming TV ads. Moving to AWS, revenue was $25 billion, an increase of 17% year over year, and AWS is now a $100 billion annualized revenue run rate business. Excluding the impact from leap year, AWS revenue increased approximately 16% year over year. During the first quarter, we saw growth in both generative AI and non-generative AI workloads across a diverse group of customers and across industries, as companies are shifting their focus towards driving innovation and bringing new workloads to the cloud. Additionally, we continue to see the impact of cost optimizations diminish. While there will always be a level of ongoing optimization, we think the majority of the recent cycle is behind us, and we're likely closer to a steady state of these optimization efforts. AWS operating income was $9.4 billion, an increase of $4.3 billion year over year. As a reminder, these results include the impact from the change in the estimated useful life of our servers, which primarily benefits the AWS segment. We made progress in managing our infrastructure and fixed costs while still growing at a healthy rate, which has resulted in improved leverage. As we've said in the past, over time we expect the AWS operating margins to fluctuate, driven in part by the level of investments we are making in the business. We remain focused on driving efficiencies across the business, which enables us to invest to support the strong growth we're seeing in AWS, including generative AI, which brings us to capital investments. As a reminder, we define these as the combination of CapEx plus equipment finance leases. In 2023, overall capital investments were $48.4 billion. As I mentioned, we're seeing strong AWS demand in both generative AI and our non-generative AI workloads, with customers signing up for longer deals and making bigger commitments. Still relatively early days in generative AI and more broadly the cloud space, and we see sizable opportunity for growth. We anticipate our overall capital expenditures to meaningfully increase year over year in 2024, primarily driven by higher infrastructure CapEx to support growth in AWS, including generative AI. Turning to our revenue guidance for Q2, net sales are expected to be between $144 billion and $149 billion, or to grow between 7% and 11% compared with the second quarter of 2023. We saw an unfavorable impact from year-over-year changes in foreign exchange in our Q1 results, and we expect that headwind to grow in the second quarter. Our Q2 net sales guidance anticipates an unfavorable foreign exchange impact of approximately 60 basis points. As part of our guidance considerations, we also continue to keep an eye on consumer spending and macro-level trends, specifically in Europe, where it appears to be a bit weaker relative to the U.S. Operating income is expected to be between $10 billion and $14 billion in Q2. This estimate includes the impact of our seasonal step-up in stock-based compensation expense, driven by the timing of our annual compensation cycle. I want to thank our customers, our partners, and our teammates around the world for a very strong start to the year, and we're excited to build on this momentum. We'll remain focused on streamlining and prioritizing projects in a way that allows us to continue inventing for customers in a cost-effective way. With that, let's move on to your questions.
At this time, we will now open the call up for questions. We ask each caller to please limit yourself to one question. If you would like to
All
ask a
right,
question,
Q&A.
please press
This is
star one
time.
on your
Let's see.
telephone keypad. We ask that when you pose your question, you pick up your handsets to provide optimum sound quality. Once again,
Amazon
to initiate a
176
question,
right
please
now.
press star, then one on your
Let's see what
touchtone
they ask
telephone
and what
at this
answers we
time.
get.
Please hold while we pull for questions. Thank you. Our first question comes from the line of Doug Anmuth with JP Morgan. Please proceed with your question.
Thanks so much for taking the question. Probably for both Andy and Brian. Historically, Amazon has shifted between periods of heavy investment and then margin expansion and back into heavier investment, but you now have a much bigger base of gross profit and overall operating income. As you think about Gen AI and capital intensity or grocery or Kuiper or healthcare, is there anything from an investment perspective that could materially impact profitability going forward in your view? Thanks.
Hi, Doug. Yeah, we have historically always mentioned that, and that you have seen like a pendulum shift sometimes between profitability and investment. I think we're at the stage now where we're doing both at the same time continually. So we are more apt to talk about the specific investments that we're making and how that might impact our short-term outlook. So if you look at the progress we made on operating income and free cash flow over really the last 18 months, a lot of it's driven by improvements in our stores business, lower cost to serve. We've talked about regionalization efforts and how that's moving into inbound areas now. Advertising has been growing strong, and AWS has been strong, and you even saw AWS margins increase 800 basis points sequentially off Q4. A lot of that's driven by cost controls and expanding revenue on the top line and lower cost structure throughout the company. We do see, though, on the CapEx side that we will be meaningfully stepping up our CapEx, and the majority of that will be in our to support AWS infrastructure and specifically generative AI efforts. So I would expect that will increase. It will increase depreciation definitely in that segment. On the when we're talking about CapEx right now, in Q1 we had $14 billion of CapEx. We expect that to be the low quarter for the year. As Andy said earlier, we are seeing strong demand signals from our customers and longer deals and larger commitments, many with generative AI components. So those signals, are giving us confidence in our expansion of capital in this area. And as he also mentioned, we've done this for 18 years. We invest capital and resources up front. We create capacity very carefully for our customers, and then we see the revenue, operating income, and free cash flow benefit for years to come after that, with strong returns on invested capital. So a little bit of long-winded answer to your question, but yes, we have but the main issue that we'll see in the near term is additional CapEx, and we've talked about that. And we continue to see strong CapEx performance in our stores business. Most of that will be related to modest capital or capacity increases, in additions to our same-day fulfillment network and some Amazon logistics upgrades to the fleet. But for the most part, what you'll see is really going to be on the AWS side.
Yeah, I just would add briefly, just to summarize. I understand where the question's coming from, Doug, and I think we're in a position to do both. Is the short answer. I think there's actually an opportunity in our existing large businesses, in the stores business, along with advertising and AWS. There's a lot of growth in front of us, and I think we're investing in a meaningful way. But I think we also, as we've been pretty consistent about, don't believe that we're at the end of what we can do in terms of improving our cost structure on the stores side. Yeah, I think there are really unbelievable growth opportunities in front of us. And I think what people sometimes forget on the AWS side, it's a $100 billion revenue run rate business that where still 85+% of the global IT spend is on premises. And if you believe that equation is going to flip, which we do, it means we have a lot of growth in front of us. And that's before the generative AI opportunity, which I don't know if any of us have seen a possibility like this in technology in a really long time. For sure since the cloud, perhaps since the internet. And unlike in the cloud, where so much there's a lot of work to be done to move from on-premises to the cloud. People do it and they get value out of it, which is why they modernize their infrastructure. But it's work. All of this generative AI set of workloads, which will transform every experience, are going to be built from scratch on the cloud, largely. And so it's just tremendous opportunities there, along with some of the other areas that we're investing that are really early stage. So I think it's both for us.
And our next question comes from the line of Ross Sandler with Barclays. Please proceed with your question.
Hey guys, somewhat related question on CapEx intensity in AWS. So I think the CEO of Anthropic has said that I think the next generation of models cost in the neighborhood of $1 billion to train. This would be like Claude 4, I guess, high end. And then the generation after that might be as much as $10 billion to train. So is this something that you feel like the industry will do on top of AWS? Do you feel like Olympus and some of the stuff you're doing in-house needs to kind of stay at the state of the art, or can others do that? And then how much did all this training have an impact on the acceleration that you saw in 1Q for AWS revenue? Thank you.
Well, Ross, I would tell you that we have seen kind of three, I'll call it macro trends that I think are contributing to AWS's performance, at least in the last quarter. I think, first of all, I think the lion's share of cost optimization is behind us. I think companies will be smart and have learned a lot over the last number of months in how they run their infrastructure in the cloud. But I think the lion's share of the cost optimization is behind us. And I think people have moved to newer initiatives that I would, at a macro level, describe as modernizing their infrastructure and then trying to drive value out of generative AI. On the former, I think we were on this march before the pandemic where most companies were trying to figure out how to move from on-premises to the cloud because it's more cost-effective and it's faster to innovate and they get real developer productivity. And then the pandemic hit, and people were in survival mode, and then the uncertain economy led people to save costs wherever they could, and they got distracted on that. But they're back to pursuing and figuring it out because it's low-hanging fruit for them, and we see very significant growth in that space. And at the same time, we're seeing very significant momentum in people trying to figure out how to run their generative AI on top of AWS. I mentioned we have a multi-billion-dollar revenue run rate that we see in AI already, and it's still relatively early days. And I think that there's, at a high level, there's a few things that we're seeing that's driving that growth. I think, first of all, there are so many companies that are still building their models, and these range from the largest foundational model builders like Anthropic, you mentioned, to every 12 to 18 months are building new models. And those models consume an incredible amount of data with a lot of tokens, and they're significant to actually go train. And a lot of those are being built on top of AWS, and I expect an increasing amount of those to be built on AWS over time because our operational performance and security, and as well as our chips, both what we offer from NVIDIA, but if you take Anthropic as an example, they're training their future models on our custom silicon on Trainium. And so I think we'll have a real opportunity for a lot of those models to run on top of AWS. I think the thing that people sometimes don't realize is that while we're in the stage that so many companies are spending money training models, once you get those models into production, which not that many companies have, but when you think about how many generative AI applications will be out there over time, most will end up being in production when you see the significant run rates. You spend much more in inference than you do in training because you train only periodically, but you're spitting out predictions and inferences all the time. And so we also see quite a few companies that are building their generative AI applications to do inference on top of AWS. And a lot of that has to do with the services. And, the primary example we see there is
how many companies, tens of thousands of companies already are building on top of Amazon Bedrock, which has the largest selection of large language models around and a set of features that make it so much easier to build a high quality, cost effective, low latency, production grade generative AI application. So we see both training and inference being really big drivers on top of AWS. And then you layer on top of that the fact that so many companies, their models and these generative AI applications are going to have the most sensitive assets and data. And it's going to matter a lot to them what kind of security they get around those applications. And yeah, if you just pay attention to what's been happening over the last year or two, not all the providers have the same track record. And we have a meaningful edge on the AWS side, so that as companies are now getting into the phase of seriously experimenting and then actually deploying these applications to production, people want to run their generative AI on top of AWS.
And the next question comes from the line of Brian Nowak with Morgan Stanley. Please proceed.
Great. Thanks for taking my questions. I have two. The first one is on cost to serve. I appreciate all the color in the shareholder letter and even tonight on cost to serve. Andy, maybe could you just help us quantify a little more how to think about some of your North Star cost to serve goals over the next couple of years, and what could that mean for potential accompanying reasonable ranges of outcomes for North America retail margins through all of that? And then the second one, if cost to serve does improve, I think it should lead to significant incremental cash flow, even with more CapEx. So just remind us again how you sort of think through the philosophy of returning capital to shareholders in addition to continue to invest for the long run. Thanks.
Hey, Brian, this is Brian. I will start with your second question. So as far as dividends or buybacks or any other capital structure moves, we don't have anything to share with you on that today. But I'll reacquaint you with our general philosophy. So our first priority is to invest in to support the growth opportunities and long-term investments within our businesses. And generally, we still have many opportunities, but that capital to use that would generate meaningful returns, especially as you've heard in generative AI. So we have a great deal of passion on that and conviction on that as well. We are reaching a different stage of free cash flow. As you mentioned, we had negative free cash flow for 2 years, 21 and 22, immediately after the pandemic, as we had doubled the size of our operations network and had a lot of other expenses. That was followed by 2023 when we had our highest free cash flow ever. So, and those trends have carried into Q1. So we feel good about the free cash flow. We are, again, still anticipating a higher CapEx this year. The other thing that we're doing with cash flow right now is we're repaying some of the debt that we had taken on during that negative free cash flow period. We had reached a high water mark at the end of Q1 last year. And since then, and then through this year, we'll pay that down over $25 billion. So that's our first priority, as well as 2024 capital expenditures. But otherwise, nothing to share on that front. I'll tee up Andy on the storage profitability, because I know there's always generally the comment about how high can operating margins go and how do they compare to historic trends. And I think the same still holds. We look back to before the pandemic and we say, first, we can achieve those operating margins even without the impact of advertising. And we're not quite there yet, but we're not limiting ourselves to that. We're looking for ways to, again, turn over every rock, look at every process and everything that we do on the logistics side, and see how can we get our cost structure down, and how can we get speed up and selection up. So it's working on a lot of fronts there, but cost is certainly front and center as we meet and improve customer experience.
And the next question comes from the line of Youssef Squali with Truist Securities. Please proceed.
Great. Thank you very much. Andy, on logistics, in September, you launched Amazon Supply Chain. Can you just help us understand the opportunity you see there? Where are you in that journey to build logistics as a service on a global basis? And does that require a step function increase in CapEx? Thank you.
Yeah, thanks for the question, Yusuf. I think that it's interesting what's happening with our the business we're building in third-party logistics, and it really kind of in some ways mirrors some of the other businesses we've gotten involved in. AWS being an example of it, even though they're very different businesses. In that we realized that we had our own internal need to build a bunch of these capabilities, and we figured that there were probably others who had those same needs, and we decided to build services out of them. So, as our business has grown, it turns out to be pretty hard work to actually import items from overseas, get them through customs and through the border, and then ship them from that point to various facilities. And then it turns out that you don't want to store those facilities in fulfillment centers because that space is really scarce. So you'd like to have them in upstream storage facilities that are very inexpensive. And then you'd like to have a way to be able to know when your more scarce supply in the fulfillment centers needs replenishment and be able to do it automatically from those upstream storage facilities. And so all of those were capabilities that we had to build for ourselves to be able to operate our stores business in the way that we wanted to and that our sellers wanted to. And so we built that capability for ourselves first, and then we opened up those services as individual services to our sellers. And so we help sellers. We have a service that allows them to get items through the border and through customs. We have a service that allows them to ship from customs to various facilities, whether they're our own or theirs, separate ones. We allow them to store items in our upstream low-cost warehouses that they can either automatically replenish into our fulfillment centers where we ship, or they can move to other facilities that they have. We have a service that lets them, where we'll ship either to our end customers if they're selling on Amazon or to their end customers. We obviously have Buy with Prime, where we enable our Prime customers to be able to buy from our third-party Buy with Prime sellers websites, which increases their conversion 25% versus what they would do on their own, and it's a great benefit for our Prime customers. And then I would say that supply chain with Amazon is really an abstraction on top of those individual building block services I just mentioned that makes it easier for customers to have the whole end-to-end supply chain integrated. That collective set of businesses is growing very significantly. It's already what I would consider a reasonable sized business. And I think it's just really early days. It is not something that we anticipate being a giant capital expense driver for us. We have to build a lot of those capabilities anyway to handle our stores business. And we think we can, it'll be a modest increase on top of that to accommodate third-party sellers. But our third-party sellers find high value in us being able to manage those components for them versus having to do it themselves, and they save money in the process.
And our next question comes from the line of Justin Post with Bank of America. Please proceed with your question.
Great. I'd like to ask a couple growth drivers that you mentioned. First, grocery. It seems like you're still changing the thresholds for free delivery or the subscription prices. Just can you say at all how much that's contributing to your growth right now? And do you think you're over the hump, or are you optimistic this can be a really big category for you? And then maybe a little bit extra on Prime Video ramp, how that ramp went versus your expectations, and do you think that could be a meaningful contributor to ad revenues, going forward? Thank you.
Yeah, I'll take them in opposite order, just on Prime Video ads. Very early days, just launched a few months ago. It's off to a really good start. I think advertisers are excited about being able to expand their ability to advertise with us in video beyond Twitch and Freevee to Prime Video shows and movies. I think they also find that the relevancy and the measurability of that type of advertising in Prime Video ads is unique for them. So it's off to a very good start. It's early days, but we're optimistic there. On grocery, I would tell you that we continue to be optimistic about what we're doing in grocery. We have a very large grocery business. It's kind of got a few different components, and we have a very significant non-perishables grocery business, much the same way that the mass merchandisers ended this business 30 or 40 years ago. These are consumables and canned goods and pet food and healthcare and beauty products. That continues to grow at a very rapid rate. We have an organic grocery business in Whole Foods Market, which is the pioneer in that space. And that business continues to grow very nicely. We're introducing a new smaller format in the fall in Manhattan in the Whole Foods Market Daily Shop idea. We've worked very hard on the profitability trajectory over the last 18 months and like the way that has taken shape. And then if you want to serve as many grocery missions as we aim to serve, you have to have a perishables business and a mass physical presence. And that's what we've been working on with Amazon Fresh. We've launched our V2 format in physical stores over the last few months, primarily in Chicago and Southern California. We like the early results a lot. They're really meaningfully better in almost every dimension. It's still early and there's some things to work through, but we like what we're seeing there. And and then we'd have to decide the best way to roll those out over time. As you mentioned, Justin, we just launched a Prime benefit for grocery, which is all you can eat delivery for $9.99 a month, which if you order once from Whole Foods a month, it pays for itself, or once from Amazon Fresh for orders under $40, it pays for itself. It's a very valuable offering for our Prime members, and it's off to a great start. So, we have in my opinion, we have lots of ways that we can continue to help customers satisfy their grocery needs. And we have some, building blocks that I think might also change how people split up their grocery orders over time. But I continue to be optimistic that that's going to continue to grow for us.
And our final question will come from the line of Ron Josey with Citi. Please proceed with your question.
Great. Thanks for taking the question. Maybe, Andy, I wanted to ask on international profitability just after 1Q's 2.8% margin. Talk to us just about where we are in terms of international getting or to consistent profitability. We're following a similar trajectory as North America in terms of benefiting from regionalization shift. And we saw what average distance of each package traveled actually came down by 25 kilometers and whatnot. And if you could provide any insights on maybe how inbound fulfillment architecture might add to just continued benefits on faster shipping, same day, next day, et cetera. Thank you, Andy.
Hey, Ron, I'm going to start with this one on international profitability. So, yes, in the quarter, our operating income was $902 million. And if you've watched that, we've seen a steady progression in operating income in our international segment. It's up $2.2 billion year over year. So we like the trend there. It breaks down into a few areas. I would say the established countries of Europe, Japan, as well as the UK are following a lot of the same trajectory as in the United States. They are profitable in their own right. They are, adding selection. They're adding new features like grocery. They're adding to their Prime benefits. And a lot of the work that we do in the United States carries over there. The second group is the emerging countries. And of course, we've launched 10 new countries in the last 7 years. Each of those has its own particular trajectory on profitability. The first thing we see there is having a good customer experience, having people sign up for Prime. A lot of times our Prime Video benefits help with that. Then work on our cost structure as we get scale, add advertising and other things. And eventually what we see is a break even, countries break even, and then they make positive income and free cash flow and are more of a contribution to the positive contribution to the international segment. So we're seeing both the emerging and the established improving. And we like the trajectory. And I think you'll see more of it as we move forward.
Yeah, I would add a few things. I mean, I'm, again, quite bullish on our international stores business. It's already a very large business. We've added a number of countries that are on the right trajectory, as Brian just indicated. And it's going to be a big, profitable business for us. And I really like the direction it's headed. I'll take also just the second part of your question, just really around continuing to work on cost structure. I'd say, first of all, on the regionalization side, which we've talked a lot about the last year, it may sound a little boring to talk about because we talked about it a lot of times, but I just tell you that we're not done there. Like a lot of the work that we've done, we still have opportunities to refine and to get more value out of that. And a lot of what we learned on the regionalization side in the U.S. was in part inspired from what we saw in Europe, which in many ways is set up as a regional network because of the nature of how close those countries are to one another. And I would say we have also learned lessons from what we've done in the U.S. that we're going to be able to apply to our international operations as well. I think we see additional opportunities in all sorts of places. A good example of which is just how and where we inbound items to. The architecture we've had set up has largely had people inbounding to a couple places, and then we took, we spent a lot of effort and time and expense in breaking those down and shipping them to lots of other places. And we believe we can be much more efficient in how we use the inbound network and how we partner with our sellers. Part of what we did with our change in seller fees, we lowered the outbound fees in a meaningful way, but then we added an incentive for our sellers to inbound into locations that allow us to be more cost following and allow both our sellers and us to enjoy in those cost savings when we're able to do so. And we're seeing very optimistic signs there too. I think we're still early with respect to how we can continue to optimize the number of units per box, which has all sorts of good benefits. And then I'd just also say that it's been really interesting to watch the same day facilities evolution in our fulfillment network. And I think a lot of people have made the assumption over the last few years that faster speeds are going to mean higher costs. And that is not the case if you build the infrastructure with the right building blocks the way we have over the last couple of years. And our same day facilities are our least expensive facilities in the network. We still have a fraction of the number of those that we will have in the U.S. and that we'll have in other parts of the world, which will, again, both change our cost structure while increasing speed. So I don't think we're at the limits of what we can do. It's not going to all happen in 1 year. We're going to be working hard at this and inventing at this for several years, but I think we have a lot of upside in front of us.
Thank you for joining us on the call today and for your questions. A replay will be available on our investor relations website for at least 3 months. We appreciate your interest in Amazon and look forward to speaking with you again next quarter.
And ladies and gentlemen, that does conclude today's teleconference. You may disconnect your lines at this time.
All right, we are done with Amazon. That was the earnings call. I'm going to stay on for another about 10 minutes and discuss some of the earnings progress we've seen so far today, given Amazon, AMD, Starbucks, and Pinterest. In general, my reflections from the Amazon earnings call is that Jassy did a fantastic job, answered all the questions that he needed to answer, didn't make any kind of core mistakes answering questions. They were very clear on what's going on with their supply chains, what's going on with the advertising that's doing phenomenal in the business, and obviously what's going on with AWS. As you can see right here, Amazon only up 1.86% after hours. And look, and we were all talking about it on the chat right here. I really do think this is a Powell issue. I think if Amazon reported when Google reported, Amazon would be closer to 190. There is no reason for Amazon to not be exploding right now. I mean, dude, they're compounding off $127 billion last year in revenue. Net income is up 229%, which means their profitability is just through the roof, on top of the $143 billion in sales. This is not a bad company by any sense of the imagination. This is not a big tech company that doesn't deserve the premium. If we look right here on Amazon, this is the V-shaped recovery that everyone's been waiting for. So we topped out at 188 back in 2021 when there was so much demand from the pandemic. And then we had a nice fall all the way bottoming at 81.43. And then from there, we've had a nice recovery back to those levels. Today's call, I think, justified us getting back to those levels. But unfortunately, as Powell is talking tomorrow, I think the market's scared. What it does mean, though, is that because Amazon's not selling off, if Powell is not super hawkish, I think we rally. And I think the entire market rallies as well. I mean, AMD is down 7%. QQQ is down 0.42%. Starbucks is down 12.42%. Robinhood is down 4.9%. Bitcoin's recovering a little bit after hours right now, so that's nice to see Bitcoin right back to that 60,000 level. It was at 59.5, and so after hours, some of the crypto stocks are recovering. But in general, that is why I think the entire market's in a little bit of a disarray right now. Amazon again up 1.53, AMD's down 7, Starbucks down 12%. Based on what I was seeing in the chat, a lot of people also said that it seems like this is a Starbucks issue versus a consumer issue. I mean, I'm getting comments here on Twitter saying that they go to a ton of different coffee shops over Starbucks, and like Starbucks is not that special anymore when it comes to getting coffee. So maybe this is a Starbucks issue. We'll see. I don't think it's a consumer issue, but we'll get more clarity over the next coming months. And the consumer report we got this morning wasn't necessarily the best in terms of the state of the consumer, but I think if Powell is not super hawkish, maybe this really is a Starbucks thing and not a consumer thing at the end of the day. Pinterest right here up 17%. They had a great earnings, highest MAUs over $500 million. And revenues up 21%. And then SMCI down 10%. I don't know what they said on the call, but the street didn't like it. Growing 200% year over year. Margins are up 100 basis points. Still, the problem with SMCI, 15.6% margins. It's not the NVIDIA, AMD type of margins. It's not 47, 48%, 50%. It's definitely not the Palantir gross margins of 80%, right? It's like SaaS margins. They build servers for GPUs. So the margins are not going to be the best, but the growth is exceptional. The thing is, the stock is already 7x at this point, more than 7x over the past year and a half. So you got to ask, is there any juice left in this one? But this one's down 10% at 768 right now after hours. I guess the street wasn't the most impressed with their numbers. And then we got Amazon at 1.4%. I mean, not a bad earnings call. Not a bad earnings call at all to me. Papa Powell is speaking at 2:30. We'll get the results at 2, so I'll be live by 2:25. And we'll discuss everything that's going on. I think that the call is not going to be horrible, but I mean, I think they're definitely going to pause. They're not going to cut. They're not going to raise. It's just the question of how bearish does he sound? How hawkish does he sound? Remember, all the Fed presidents have been saying they think inflation's much tougher than they thought it was. The market was expecting 6 rate cuts in December. We were expecting the first in March. That has been obliterated. Larry Fink said we're going to be lucky if we get 1 or 2 cuts. I think we're definitely getting 1. And if that's pushed out till September, maybe we have a few months of being in purgatory unless the bull market continues and we do see inflation data coming down and Q2 earnings is just as good as Q1 earnings. We needed Amazon to have a stellar earnings like Google, Microsoft, Meta. They executed. The stock is the stock, but they executed. This was a phenomenal earnings by Amazon. And now Apple, which we'll see on Thursday how they do. If they can hold up their end of the bargain along with NVIDIA, then we should be all right. Even Tesla, not the best earnings, but still they were able to hold some momentum given what Elon has laid out in terms of their vision. And they've executed against that as well. We got Michael Wilder in the chat saying, I'm buying more Amazon tomorrow, especially if it dips. I don't think it's the craziest idea. I mean, let's look at the price action real quick on Amazon. When's the last time Amazon got to the 160s? Let's look at the year to date. So year to date, Amazon was, 144 in January. Look at that. 144 in January, hit 190 2 weeks ago. Got to 171, then stalled out for a little bit. So 177 right now. Yeah, I don't know if this thing, it went to 166 a couple of days ago. I don't know if this thing is going back down to like 155-ish, but if it sells off tomorrow, this earnings was definitely not a reason for it to sell off. It'll probably be a bit more macro. All right. That's it for me. Thank you everybody for being here. Glad you guys, or hope you guys enjoyed. We'll be live for the market open tomorrow, 8:45 a.m. Tomorrow, early in the morning, do we have anything special? Today, we did have PayPal. We do have the Fed meeting tomorrow. That'll be important. We're streaming that at 2:25. Tomorrow's May 1st. Wow. 5 months into the year, folks. We're going to be in May. Before the open, we have MasterCard, ADP, CVS, Marriott, Pfizer, Wingstop. That stock's had a really good run. Anything else? Nothing too. Kraft Heinz, Buffett stock. That's pretty much it. Nothing too crazy. And then we have Riot as well. Riot Platforms. I think this is the Bitcoin stock. Yeah, I believe this is the Bitcoin mining stock. And then after hours, tomorrow we have DoorDash, Qualcomm, Etsy. That's a good one. And Novix. That's a big one. That's one people care about. And MGM and Carvana. So nothing too crazy. Nothing too crazy tomorrow. But so far, earnings season has been okay. Finance Junkies will be tonight. Yes, the reason we canceled yesterday is because there weren't that many earnings. We knew that there would be more earnings today. So Finance Junkies tonight at 9 p.m. and we'll discuss everything going on in the world of earnings. All right. Thank you all for being here. I appreciate it. If you are new to the channel, consider subscribing. We do a market open and market close every single day. And we'll be back tomorrow and keep going. And we'll keep going from there. Thank you, everybody, for being here. Appreciated. The Knicks play tonight. We'll see what happens. I usually don't watch the Knicks. The Knicks were my first basketball team that I loved, but then I just became a LeBron fan, and so I stopped watching the Knicks. But I think I might watch the Knicks tonight because if we win our first playoff series in a long time, that would be nice to see. 9 p.m. for Finance Junkies. 9 p.m. for the Junkies. All right, everybody. Enjoy. I'll see you guys tomorrow, 8:45 a.m. in the morning. Bye, everyone. Have a good one. Good night. And thank you for joining again. Do not take it for granted. It means the world to me. This is the most fun thing in the world to do. And I appreciate you guys being here. The chat also is the funniest chat in the world. I mean, this is we have literally have the funniest chat on the planet. And it makes sense. I'm the funniest guy on the planet. So the chat should be a reflection of me. And you guys are a very good reflection of me. And the humor can keep up. So congrats. It's really good. We're funny. We pulled it off. 9 p.m. Eastern. 9 p.m. Eastern. I'm just kidding. I love you guys. Thank you. See you guys tomorrow. Good night. Bye-bye.